All right, so we'll be looking at cost of capital and we try to touch on business valuation as well. So we'll be doing business valuation and cost of capital, and we'll be continuing with time value of money and financial risk management are done. Okay, so if you come to cost of capital, what are the cost of capital is not a major topic. When if you come to uh, financial management, it's not a topic that you have to be seeing every sitting. No, it's not part of those topics that will be coming every sitting. But you need to have an idea about working capital. That's a working capital, cost of capital, so that you can be able to do some issues on the business valuation. So if you come to cost of capital, what are the things that they are going to be examining you on? Okay, the cost of capital. Okay, the most examined area is what we call the weighted average cost of capital. Okay, the most examined area is the weighted average cost of capital. They can also ask you maybe a question on cost of equity. Okay, they can ask you on cost of equity where you have to use a dividend valuation model. We use the dividend valuation model, or we use the what we call the CAPM, the capital asset pricing model, because the dividend valuation model is based on assumption that dividend is constant and dividend is going to be growing at a constant rate, which in actual sense is not going to be the case. And the dividend is also not what we don't take into consideration the risks associated with the securities. Okay, we assume that everything is going to be okay and dividends payment will be there. So it does not take into consideration the risks associated with the security. So we try to look at what the risk elements. So a cost of capital should be based on what the risks that the instrument is bringing. So we factor in the risks and we now come with the CAPM. Okay, the cost of equity can either be the dividend valuation model or CAPM. They can also ask you cost of debt, and the debt you have to understand what we call the irredeemable debt. If it is irredeemable debt, how this is going to be. If it is redeemable, how do we calculate our cost of debt? The cost of debt is just the what? The interest. The interest is what you are paying, which is what we call the cost of debt. So what percentage of the current market value is giving you the interest that you are paying? That is what we call the cost. Okay. And they can also talk about the cost of convertible. So the cost of convertible bond and maybe a cost of preference shares, and also how to find a specific cost of equity for a project. A company will be in the hospitality industry or they will be in the music industry and they want to venture into a project that is different from what they are doing. They want to enter into a different operation. So you are in the music industry, you now want to venture into the manufacturing industry, like food industry, hospitality industry. That is a different That is a different uh, operation on its own. That is a different project on its own, which is going to be coming with a different operational risks. So how do we calculate the cost of capital that we are going to be using to appraise that particular project, which we call the cost of specific project. We'll be looking at that one also. Then basically that is all for cost of capital. We'll be looking at dividend, business valuation. We'll be looking at business valuation. And then for business valuation, we'll be looking at valuation of equity. And valuation of equity, we have so many methods that we can use. So we'll be looking at valuation of equity. We'll be looking at valuation of debt. We try to pick question on each of them. Valuation of debt. Then we also look at issues about mergers and acquisition. Mostly, the question will be in your theory form for mergers and acquisition. Mostly, the question will be in a theory form for mergers and acquisition. They have only examined the calculation side only once, but unfortunately, I don't have any question on that. But you can check the YouTube channel. I have a full lecture on mergers and acquisitions. So these are the things that we are going to be doing. So we'll be looking at cost of capital, which mostly it will be about the WACC, weighted average number of shares, as a weighted average number of shares. The weighted average cost of capital, then they can also examine you on cost of equity, or they can examine you on any of them. So we'll be looking at them one by one, and we don't want to waste time because we have to do our own lessons as well. So let's pick question number 1, and we see what we can do. Question number 2, we see what we can do. Question number 3, we see what we can do, and that order. So Auntie Patricia, are you there?
Yes, please.
Yes, ma'am.
Question 1. Edike Limited wants to raise 150,000 Ghana cedis additional funds to undertake an expansion of its operations. The current capital structure is as follows: 1 million ordinary shares, nominal value 1, market value 0.5, 5 million 1.6% debenture, nominal value 1, market value 0.1. It is estimated that the cost of equity is 15%. In raising the additional capital, the company is considering 2 options. The first one, raise 75,000 Ghana cedis of equity finance and 75,000 Ghana cedis of debt finance. Second option, raise 150,000 of debt finance, in which case the cost of equity will increase by 33 and 1/3%. Required. Recommend the best option Edike should adopt. Assume a corporate tax of 25%.
All right, thank you.
Okay.
All right, let's finish that one first. So this is a question on a company deciding to raise a finance. Okay, this is about a capital structure of the entity. Okay, what is going to happen is that the money that the company is raising right now, okay, the money that the company wants to raise might be coming with the same cost that you are currently incurring on debt. So if you are looking for the cost of the debt and the cost of equity, that is not going to be telling you whether the company should go ahead or not. Okay, you can ask yourself, what is the existing cost of capital in terms of WACC? If you are now using both the equity and debt, what is the cost? What is the weighted average cost of capital for them? Okay, if you're now bringing in the new one, what will now be the new cost for the finance now? That is how you are going to be looking at this question. The company is currently being financed through equity and debt. Okay, the question now is, you have to ask yourself, currently, what is our cost of capital? Using both equity and debt, what is our cost of capital? Okay, if we are now bringing a new finances now, or the additional funds now, what will now be the new cost of capital? So you compare your current cost of capital to your new cost of capital after the investment. So what we are going to be doing is that this question is just about WACC. You are using equity and debt. So currently, what is the cost for both, which is what we call the weighted average cost of capital. After you have now introduced, or after you have now raised the money, what will now be the new cost of capital? You compare and see whether you should go ahead, or you should maintain your existing position, or you should go for any of the options. So what we have to do now is that we need to find our current cost of the current cost of capital for the entity, which is the WACC. How do we find WACC? The WACC is not anything. The WACC is just that, okay, we look for the total interest, or the total cost in terms of money, and the total amount of the entity. So what percentage of our total value currently can give us the cost or the interest that we are paying on the 2 options. So you have to calculate your cost of, or the weighted average cost of capital currently, and you try to look at what will be the cost of capital under each of the options. Then you choose the option that is most appropriate for the entity. So we don't have to. So let me come to this one. Question number 1. A, we have the decay. Okay. So what we do is that we need to find our weighted average cost of capital, which is calculated as the VE divided by VE plus VD multiplied by the cost of equity plus VD, which is a value of debt, divided by VE plus VD multiplied by the cost of debt, or the after-tax cost of debt. So what we have to do is that we have to find the value of equity. We need to find the value of equity. Okay, we need to find the value of equity under the option 1. We need to
Hello,
find the
senior.
current. Yes, senior.
When we quoted under the debt, I didn't see us factoring the tax component in it.
I mentioned after tax cost of debt.
Oh, okay.
Okay. Okay. So let's look at currently, what is our value of equity? So let's look at the options. What is our value of equity? Currently, what is our market value of equity?
0.5.
0 points. Currently, that is a value. That is a value per a share. So what will be our total value of equity, the market value of equity? We have 1 million.
500,000.
Okay. That will be 500,000. So that will be the 0.5 multiplied by the 1 million shares that we have. Okay. So that will give us 500,000 Ghana cedis. Okay. We know the cost of equity currently, isn't it? Okay. So our cost of equity is currently 15%. Okay. Can we calculate our current value of debt? Our current value of debt will be what?
Linus, please, can you go back to the slide? No, the slide before this one. So is it not the KE, which is 2%?
Yeah.
On the next slide, the cost of equity is 15%.
Yes, please.
But you've written KD, that's cost of debt, to be 15%.
Really?
I mean, that's the cost of. Okay.
The value of debt will be 500,000.
Value of debt is also 500,000.
Yeah, 1 by.
Is it 500? 1 by this
500.
is 6 million.
500.
It's 500.
5 million.
Okay, sorry.
It's 5 million.
Okay. So we have 5 million. So our VD will be equal to
500,000 cedis.
Okay. Okay. The question now is, they say you should recommend the best option the K Limited should adopt. Okay. So it is very important for us to know our existing cost of capital. So we now have the VE, we have the VD also. We need the cost of debt now. Okay. If nothing has been said about this, you assume that the debt instruments, which the debenture, is irredeemable. Okay. If nothing has been said, the debt component is what? The debt is irredeemable. Yes, Nakafu.
So, sir, to get the value of debt, is it the X interest price multiplied by the number of ordinary shares?
No, the debt is 5 million, 1.6% debenture. So we find this one based on market values. We find the weighted average cost of capital based on market values. So their market value are 50 pesos and 10 pesos. And we have 5 million debentures. So the market value multiplied by the number of debentures that we have, that is the value of the debt.
Okay.
All right. So I'm saying that if nothing has been said, then your debt instrument should be assumed to be irredeemable. Okay. What is the interest that we are paying? What is the interest that we are paying every year on the debenture? What will be the interest? What will be the interest that we are paying every year on the debt instruments? The interest
1.6%.
1.6%.
No, I want the amounts.
Oh, okay.
How much are we paying every year? We are looking for the value per.
80,000.
No, don't do it on total basis. Do it on unit basis. Okay.
It's 1.6.
Okay. If you can do it on unit basis, no problem. Okay. If you can do it on total basis, too, no problem. But it always should be on the nominal value. Okay.
1.6.
So if you are doing this, what are you getting? If you apply it on this value, what are you getting? If you apply it on the nominal value, what are you getting?
1.6.
Are you sure?
0.016.
0.016. Okay. The interest will be on 1 cedi, which is the nominal value. So 1.16% divided 1.16 multiplied by that, or 1.6 divided by 100% multiplied by 1. That will give you 0.016 Ghana cedis. 0. So we can have your 0.016. Okay.
0.0016 or 0.016.
0.1016.
Because the 1.6% itself is 0.016.
And so
Multiplied by
you're doing
one.
you're doing it on the
Okay,
nominal
against the
value of 1 cedi.
nominal value. Okay, all right, thanks.
Okay. Do you have tax element there?
25%.
Okay. So it means that this is the amount that we are going to be paying every year. But what is going to happen is that the interest is tax deductible. So instead of us paying a tax of 25% on our profits, we are going to be subtracting the interest. So the interest is giving us a tax benefit of 25%. So indirectly, we are paying 75% to the holders of this particular one. Divided by the market value is what?
0.1.
Okay. Divided by the market value to be 0.1. So all of this multiplied by 100. So what is our cost of debt?
12%.
12. Okay. Okay. So our cost of debt is 12%. Okay. You can also calculate the cost of debt like this. Okay. Alternatively, what will be your cost of debt? Okay. We are looking for the interest. Okay. The interest will always be paid.
Enter to Bluetooth.
The interest will always be paid on the nominal value. The nominal value means, okay, how much are you taking from what? From the debenture holders. So if you are issuing the debentures for 10,000, you are going to be paying the interest on the 10,000. That is it. But we just want to know what is the current what? Cost of capital. If we should pay this interest on the current value of the debenture, what should have been the percentage? That's what we are trying to find. Okay, so you can see that our nominal total value, okay, our nominal value which will be the total, will be the 1 cedi multiplied by the 5 million. Okay, will be the 1 cedi multiplied by 5 million. That will be the total value, and this will give us 5 million Ghana cedis. Okay, what is going to happen is that let's calculate the interest on the total. So what will be the interest that we are paying on this amount every year? Okay, so what will be the interest?
80,000.
It will be
80,000.
okay. Okay, so this one will give us 30 or 20.
80,000.
Okay, 80. Okay, this is the interest that we are going to be paying every year, but this interest will be allowed to, the tax authority will allow us to subtract it from our profit before they charge the tax. So it means that if we are not paying this particular interest, we are going to be paying a tax that will be on a particular amount of 80,000, because we are not going to be subtracting the 80,000 from the profit before we charge the tax. So we are going to be paying a tax of 20% on that. But since they are now allowing us to subtract this, it means that the tax that we should have paid on the profit element, which is 80,000, it will not be given to us as a benefit. So indirectly, we are paying the 80,000 to the people, but the tax authority is also, or we are enjoying a tax benefit, or this interest is giving us a tax benefit of 25%. So indirectly, we are only paying 75% to what? To the holders. Although we are paying all the 80,000, but this 80,000 is giving us a benefit of what? 25%. So what is the net amount that we are paying? Indirectly, we are paying 75%. So that is why we normally find the after tax what? Interest for this one, because the interest is going to be giving benefit to the entity. So if we are enjoying that benefit of 25%, it means that indirectly we are only paying what? 75% to those people. Although you'll be paying the 100% amount, but what are you paying? Indirectly, you are paying the 75%. So your cost of debt will now be calculated as the 80,000 into bracket 1 minus 0.25, which will give you the 75%, the actual amount that you are paying, divided by, you look at the market value of 500,000. If you are doing it like this, you are calculating it on total basis. So 75% of that, what are we getting? What are we getting? Are you getting 12%?
12%.
Okay. But mostly it is calculated on the unit basis. This, all bonds or all debentures are assumed to be issued in what? In units, and each unit is 100 cedis. So in the exam, if you are not given the nominal value is 100 cedis, because these bonds are assumed to be issued in what? In units, and each unit is what? Is 100 cedis. So nominal value will always be 100 cedis if you are not given. Okay, let's now calculate our current weighted average cost of capital. So our current weighted average cost of capital, that is without this one, will be our value of equity, which is 500,000. So we have 500,000. Let's keep 3 zeros, divided by the value of equity plus the value of debt itself, all on market value basis, multiplied by 15%, then plus the 500,000 divided by the 500 plus 500 multiplied by 12%. Okay, we have 0.5 multiplied by 15% plus 0.5 multiplied by 12%. What are we having? 7.5% plus 6%, 13.5%. Is that correct?
Yes.
Okay. Let's come to the options now. This is our current, okay, this is our current weighted average cost of capital without the investment. Let's come to the options now. Option 1, if we want to raise the money, option 1, we want to raise 150,000. Okay. Option 1, what are they saying about the option 1? We should raise 75,000 of equity finance and 75,000 of debt finance. Okay, if we are doing this now, what will now be our new weighted average cost of capital under the option 1? Okay, since they are not saying anything, it means that your cost of the various items are going to be the same. The cost of equity will still be 15% and the cost of debt will still be 12%. But what will be the impact of these additions on our weighted average cost of capital? So our decision will be based on the weighted average cost of capital, because the equity will be coming at the same cost. We'll still be paying the 15% to whatever is going to be happening. The shareholders that are coming, our existing cost of equity, the dividend is 15%, or our dividend yield is 15%. And that's what we are going to be paying on the market price of the share. So we'll still be 15%. Our cost of debt is still 12%. That means that whatever is going to happen over here is that our value of equity and the debt is going to be increasing. So how would this impact our weighted average cost of capital? So we need to calculate the weighted average cost of capital under the option 1 also. So the option 1, we now have our WACC to be 575. Okay, I hope you're okay with the 575.
The additional 75,000.
Okay. Okay. Divided by 575 plus 575. Is that correct? Okay. Debt will also increase by, we are doing half. Okay. So multiply by our existing, like this will be 15% plus, we now have 575 divided by 575 multiplied by 12%. Okay. So let's move on. What are we going to be having over there? We will still have the WACC to be would that still be 0.5?
0.75. Okay, the first part.
Yeah.
0.075. So 7.5.
It's to be 0.5.
It will still be the 0.5.
Yes.
The 575 divided by this one will still be 0.5 multiplied by 15%, isn't it?
Yeah.
Okay. Multiplied by 15%. And the last one will also be 0.5 multiplied by the 12%. Okay. So this will still be 7.5. This will still be 6%. So this will still be our 13.5. So our WACC will still be this, our WACC will still be the same value. Okay. They haven't said anything about the cost of debt changing. So the bonds that we are going to be issuing, the debt instrument that we are going to be issuing, the market value will still be 0.1 and the nominal value will still be 1. So if you are calculating it on the unit basis or on total basis, you are still going to be getting the 12% as the cost of the debt at the end of the day. So you don't have to go and say you are trying to check if you can calculate the cost of debt under the new one. It will still be the 12%. It will still be the 12%. If you like, you can try and see whether it will still be okay. It will still be the 12%. Okay, so you just use the existing cost to find. So let's come to our option 2. Nothing is happening to our existing cost of capital is still 13%. Okay, let's now come to option 2. Option 2, what are they saying there? We want to raise 150 of debt finance in which What are they trying to say? Cost of debt increase, the cost of equity will increase by 33 whole number 1/3%. Okay, what we are going to be doing is that we have if you come to capital structure, we have so many views about capital structure. We have so many theories. We have the traditional view. The traditional view is saying that as the company is highly geared, if the company is highly geared, as the debt component, the capital structure, the debt component keeps increasing, shareholders will now be demanding for what? A higher cost of capital. Why? Because they are seeing that the company will eventually be out of business. So what we want to do is that we have to get a higher return so that we can be able to recoup our investment before the company will be out of business. So if you are raising this through debt, it means that it's increasing the financial risks of the entity, which might eventually lead the entity into a bankruptcy, and our money are going to be losing. So it means that we have to increase our return. The company is now facing a lot of risk. So if you're having a higher debt, the cost of equity will be increasing because the shareholders are scared that the company might be out of business and the investment might be a waste and they will not get anything from it. So they have to increase their return so that they can quickly recover their investment through the return that you are giving to them. Okay, so since we are now raising the 152 owning debt, they are saying that the cost of equity will now increase by 33 whole number 1/3. The cost of debt will still be 12%, but the equity will now be increasing. So what will now be our new WACC under this one? So we need to now look for the WACC. Looking for the WACC now will be 500 because the equity will not be increasing. The equity will still be, the market value of the equity will still be the 500 divided by, now it will be 500 plus a debt of 650. Okay, so we now have to calculate the new cost of equity, which we are going to be calculating very soon. So we multiply by the new cost of equity. Then you now come to your debt component. Your debt component will now be 650 divided by 500 plus 650 multiplied by 12%. Okay, let's come to the cost of equity now. What is the current cost of equity?
15%.
Okay, let's say this is increasing by what?
33
1/3.
1/3.
Okay, so we need to find a new one. Okay, so our new cost of equity will be calculated like this. So let's come to the new KE will be calculated like this. Let's change the 33 whole number 1/3 to a fraction. Would that be 1/3?
And to be 33.33 if it's a decimal.
Yeah, it should be 1/3.
That will be done as 100/3. Is that correct? If you change it to so 100/3%, isn't it?
Yeah.
Okay. So if you have 100/3%, this is the same as divided by 100. Okay. 100/3% is the same as divided by 100, isn't it? So we have the 100/3. Then we change this one upside down, multiply by 1/100.
100.
So this and this, that will give us 1/3. So we need to find the increment in the what? So our new one now will now be the 15% plus the increment of 1/3 multiplied by the 15%. Are we okay? Are we okay with that?
That will give us 20%.
Okay. So the new cost of equity now is 20%. So you now come and multiply by 20% here. So we have 500 divided by 1150 multiplied by 20% plus 650 divided by 1150 multiplied by 12%. Okay, what are we having?
8.6, 8.7.
For the first one.
For equity side.
Okay, 8.7.
There's 6.78 or
Yes,
6.8.
6.8.
6.8, yes.
Okay. So the total is what?
15.48.
Okay. So which of the options will you have, are you going to be advising them on?
Option 1.
Option.
Option 1.
Oh, okay. Okay.
Please, can you go over the calculation of the new cost of equity? Because I had a call around that time, so I missed that. But just
That is an opportunity cost in there. Okay. They are saying that the cost of equity is increased by, or the current cost of equity will increase by 33 whole number 1/3. So you just multiply the current one by the 33 whole number 1/3. That will give you the increment. If they are telling you that the amount that you are receiving will increase by 20%, just find the increment. How do you find the increment? 20% on the current amount. So we change the 33 whole number 1/3 to a proper fraction. Okay, and we have 1/3. Then we multiply by the current equity, cost of equity, that is 15%. We are getting 5%. So it means that the current cost will now be increasing by 5. So we add the 5 to that one and get the 20%. So that will be the current cost of what? The new cost of equity if they are now using the debt, only debt to finance the project. All right, please, if you are given a question and they are talking about capital structure, the only two things that you have to look for. Yesterday, you can see that we calculated the financial gearing because the question was asking for financial gearing. So we look at the impact of the financial gearing. Okay, and we say that they should use a right issue. Another way is that they can give you the cost of the items. They can give you the cost of the items. If you're not giving the cost of the items, then the other way is to find your financial gearing. Okay, so this question, we can also find the financial gearing, which is the capital structure of the entity. We can use the current capital structure of the entity. If we are using this one, if we are using capital structure, or if we are using financial gearing to also advise them, assuming the cost of the items are not given, or we don't have to use WACC, we can also use the financial gearing ratio, the composition of debt in the capital structure. So we know that the debt component is 500,000. We do it on current values. Okay. And the equity component is also 500,000.
500.
Okay. So we have to find our financial gearing now. Okay. We have our financial gearing now. To be financial gearing will be the debt over equity plus the debt. That is just like capital gearing. Okay. So we can do this and have 500 over 1,000. Okay. That will give us, multiply by 100, that will give us 50%. So this is your existing one. Then you go to the next option now. Okay. The next option, you can see that the top and then the down will be increasing by, the top will increase by 75, the down will increase by 150 because the equity is 75, the debt is 75. So it will still be giving you 50%. Then you now count to the new one now. If you count to the new one, you see that it's only the top that will be increasing by 650. The debt will be increasing by 650, but the equity will not be increasing by anything, but you still be having debt to be 650. So this will give you 650 over 150 multiplied by 100. What are we getting?
56.52.
Okay. So you can see that the first option, you are still having the same capital composition like the current one. But if you're now using for debt alone, you are having a gearing ratio of 56.52%. So you can ignore this one because this is going to be increasing your what? Your gearing ratio. So you can go for the option one. If you are not to ask for, or if you're not to calculate for the WACC, you can use the capital gearing to also advise them what they should do. Okay. I also want to show you another way of calculating the cost of equity or the WACC without doing anything. Okay. What is the existing? We have equity to be 500,000. Okay. And we have our debt to be 500,000. Okay. Our cost of equity is 15%, isn't it?
Yes.
Okay. The cost of equity just means that is the dividend that we are paying on the what? To the shareholders. That is the dividend that we are paying to the shareholders currently. So if the market value is 500,000 and the percentage that we are paying to the people is 15%, how much are we going to be paying to them? That will be 0.15 multiplied by 500,000. How much are we paying there?
75,000.
Okay, that will be 75,000. Okay, let's come to the return on the debt too. What will be the return on the debt? Our current cost of debt is 12% multiplied by that amount. So how much are we currently paying to these people?
60,000.
60,000. Okay. What is the total return that we are paying for using these sources of finance? What is the total amount that we are paying for using this?
135,000.
135.
Okay. This 135,000 is paid out of a total amount of what?
Total 100,000.
Okay. Total amount
1,000.
1,000. So you can do this and you'll be finding your work. This is one way of finding the work too. So you can just calculate your total interest. The total interest should be on the current market value because the work is always calculated on the current market value, unless the question is asking you to use book values. So what is the total interest that we are paying? Okay, we are paying the interest on what amounts? So the question now is that we are paying interest on 100,000 or we are paying a return on 100,000. That is the current amount that we are paying the return on. But the question is, what percentage of this total amount of 100,000, because we are using 100,000 or 100 million, what percentage of the 100 million is equivalent to what the total amount that we are paying? So we are just looking for a percentage that if we apply it on this one, it will be the same as what the two returns that we are paying. And that is going to be giving us 13.5%. So if you like, apply the 13.5% on the 1 million, you'll be getting 135,000. So what rate? We cannot use 12% and 15%. No. What rate that if we apply it on the debt and the equity, the amount that we are paying the return on, what rate that if we apply it on it, it is going to be giving us the 75,000 together with the 60,000. That is what we call the WACC. Okay, that is what we call the WACC. So you can also calculate the WACC using that particular approach. There is no problem with that. Also, Auntie Patrick.
Sir, please, someone called your name.
Yeah,
Hello, sir.
my name is
Yes,
Lionel.
Okay, please, I was asking, you see the 13.5 we got as compared to the first one we computed? I think there is a variance, or it doesn't matter.
Which one?
Please, come on the whiteboard, please. I think we got we say 15 points.
4.8.
15.48.
It's supposed to be 15.5.
It's supposed to be
So the one
15.5.
Yeah, and then the one you just computed, the 13.5. You see,
Yeah.
using this approach and the other approach, I mean, like, Is it acceptable? Like we get different work.
Now, if you use, what did you get for the 15? If you use the one that I've used over here, the work, what did you get?
I
The
got 13.5 for the new approach.
this one, the one that
Yeah.
I've used over here, this is the existing one that I've calculated without taking into
Oh, okay.
consideration the options. So if you are
Oh,
doing
okay,
it for the
okay.
options, it means that your cost of equity for this one, let me claim this one. Okay. Your return on equity have to be like this. So at every point in time, it should be on the existing market values. Okay. So your return on equity, if I want to use that one, our return on equity will now be 0.2 multiplied by the equity value of 500,000. I'm sure that will give us 100,000, isn't it?
Yes, please.
Okay. Then our return on debt will now be the 0.12 multiplied by 650,000 because the current value of the debt is 650,000. I hope that is clear.
Yes.
Okay. What are we getting for that?
The 78,000.
Okay. So you have so the total interest that you are paying now is 178,000. Okay. On what
Yeah.
amount? Okay. So you are paying this on 1,150,000. So what percentage of 1,150,000 will give us a 178? That's what we are looking for. So you have 178 divided by 115 multiplied by 100. You need to be getting something like 15.5%.
Yeah.
15.48.
Okay.
Yeah.
So it
Okay.
doesn't
Thank you.
matter. All right. So I mean I use all of them, but just pick the one. I always provide people with so many alternatives so that in the exam hall, if you cannot recall the one that you know, you just have to be creative in whatever you are doing. Okay. B part.
B. EFG Limited issued 300,000 15% preference shares of 100 Ghana cedis each, redeemable at 10% premium after 20 years. Flotation costs amounted to 3 million Ghana cedis. Required. Determine the cost of preference shares capital, where the shares are issued at A, par, B, a premium of 10%, C, a discount of 10%.
Okay. Yeah, so you see the question looks very simple, isn't it? Okay. But it is stronger than a situation where they will give you a question on a one sheet and nothing will be there. It's very simple. Okay. This is redeemable preference share, isn't it? Okay.
Yeah.
The cost of redeemable preference shares are treated in the same way as what? Cost of redeemable what? Debt, isn't it? Okay. Just that the debt we find tax component because the interest on the debt will be tax deductible. But if you come to preference dividends are not going to be tax deductible. They are going to be paid out of profit. So we don't find after tax element on them. Okay. But the question now is they are asking us to find the cost of the preference share. This is if this is redeemable, it will be calculated like how we calculate what the cost of redeemable debt. So we need to find the internal rate of return for this particular instrument one by one. So we have to now use the internal rate of return. But if it is irredeemable, we just calculate it like what? The cost of irredeemable debt, where we look at the dividend that we are paying on the preference shares divided by the what? The current market price of what? The preference shares. Okay. What is the flotation cost? What are they saying the flotation cost?
It's 3 million.
Flotation cost is what?
3 million.
No, I'm not talking about the amount. I can see the amounts. 3 million, yeah. Flotation cost. What are they talking about? Yes, flotation.
15%.
No, flotation cost is the issue cost. That is all. Okay. And issue cost, when you come to cost of equity, the issuing costs are just treated like what? A normal transaction cost under financial instrument. The issue cost is always netted against what? Against the market value. Okay. So this one, they are not giving us the market value of the preference share. So we assume that the issue amount, which is 100 cedis multiplied by the number of shares issued, is the same as the market value. So let's find the cost of the preference shares if it is done at par. So we look at the first one, B, which will be the B. Let's look at this if it is done at par. Okay. Let's look at the market value of the preference shares. Okay, that will be 100 multiplied by 300,000. That is the shares that they are issuing, isn't it?
Yes.
Okay, so how much are we going to be having?
30 million.
Okay, that will be 30 million. Okay, so this cost should be net of cost. So net of issue cost. Okay, so we treat the issue cost like how we treat the normal transaction cost under financial instruments. So the issue cost will be settled or will be net against what? The amount that we are receiving. So let's count to the 30 million minus what? 3 million. Is that correct?
Yes.
Okay. So that will give us
27
million. Okay. All right. Let's count to the dividend that we are going to be paying every year. What will be the dividends? What will be the dividend that will be paid on the preference shares every year?
15% of 30 million.
Okay, so we have 15% of the 30 million. That will be the dividend.
4,500,000.
Okay, so the dividend payment every year will be 4,500,000. Okay, let's come here. When are they saying that this will be redeemed?
20 years.
20 years.
Okay, 20 years are then. So let's find our. We are going to be looking for. This is redeemable, so we'll be using the internal rate of return. So we are going to be picking a rate. So we have our years here, our cash flow here, and we have our
discount factor.
We have our discount factor. Then we have our present value. Please, you can also try to do this on unit basis. If you want to do it on unit basis, what will happen is that you are going to be finding your issuing cost per shares, because you can say that a share is 100 cedis, isn't it?
Yes.
Okay. So if you are incurring 3 million for 300,000 shares, what will be the issue cost per share? So you can find the issue cost per share and subtract it from this one. That will give you the market value. Okay, let's try that one. I'm sure that will give us the
3,000.
issue cost.
30,000.
Are you sure? 30,000 divided by, would that give us 10?
It will give us 30,000.
No, the issue cost per share, it will be 300 million thousand divided by 300 shares. Okay, that will give us 10, isn't it?
Yes.
Okay, and you subtract the 10. You subtract the 10 from the 100. What are you going to be getting?
90.
Okay, it is the same as you dividing the 27 million divided by 300,000. You'll still be getting 90 per share. So you can also do it on share basis, per unit basis, but we are doing it on total basis. So this will always start with year zero. The year zero is the current market value. Okay, the current market value, which is currently is 27 million. So we bring this one as outflow. This will be 1.00, then this will come in as 27 million. Then we come to this place. We are going to be paying dividend for how many years?
20 years.
Okay, let's use 20%, 10% first. Okay, so the dividend will be 4.5 million for 20 years. Okay, so we can use annuity for that because that is going to be every year will be 4.5 for 20 years. So annuity 10% for 20 years.
Give us 8.51.
Okay, 8.51. Okay. At the end of the 20th year, what is going to happen?
We'll discount it, we'll redeem it.
Redeem it at what?
10% premium.
At a premium of what?
But the first one,
Premium of 10%.
the first one is par.
And the first option is at par.
No.
15%.
No, you have to get a requirement for the question. They say determine the cost of preference shares capital where the shares are issued at par. So if the shares are issued at par, it means that the current market value is the same as the par value. Okay, but whatever
Yes.
be the case, it will still be redeemed. Whatever be the option, it will be redeemed at what? At a premium. But we are only talking about
Redeem at
issuing
premium.
price. Yeah, we are only talking about the issuing price. This is about issuing price, not about the redemption. The redemption will still be at premium for all of them. Okay, if the shares are issued at par, not they are redeemed at par, no. Okay. So let's count to, they'll be redeemed at premium, and if they are redeemed at premium, what will be the amount that they're supposed to be paying?
Senior Linus,
Yes, please.
the discount factor will be 8.514.
Okay. 8.514. Okay. If we are redeeming at premium, how much are they paying? If they are redeeming at par, it will be 30 million. Now you are paying 10% in addition. Would that be 33 million?
Yes.
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 Okay. So that will be 33 million. Okay. The discount factor, this will be done at the end of the 20th year. So what will be the discount factor at the end of the 20th year? What are we getting?
0.15.
0.1.
149.
Okay. 0.149. Okay, so let's now find our values now. Okay, please, can we change these ones to million? Let me just change them to million. Oh, let me keep 3 zeros at the top.
Hello, Linus.
Yes, please.
Please, can I know where the 33 million is coming from?
Someone should help.
10% of 30 million plus the 30 million.
Okay, thank you.
Okay, so let's now find, I'm keeping 3 zeros at the top there. So let's
38, 31, 3 for the first one.
okay, 38, 31, 3. Okay, the last one will be what?
4917.
4917.
17.
Okay, are we having positive or negative?
Positive.
Positive.
Positive over how much?
One
16,000.
1?
16,230.
16,230. Okay, so what do we have to do? The next discount factor should be what? Should be
You should
in.
increase it to 25.
To be higher.
Okay, what rate can we use? 30, 20% is 10% is now giving us 16. So can we try 35?
Let's use 30 or 40.
Okay. You have to pick a rational rate. If not, you can pick a rate, you'll still be getting a positive again. So just look at the difference over here. This is 16,000. So maybe if you pick 20, you'll still be getting positive. If you pick 25, you'll still be getting positive. So you can just pick maybe 35 or 40, but don't go and pick 70. No. Okay, the margin between them should be what? Should be rational. So let's come to the next one. We will still be using the same values, but just that the discount factor is going to be changing. So we have a discount factor. Let's use 35% and see. We have the present value. So we still have year 0, 27,000. We'll still be using the same figures, but just that. So just that the rate will be different. So we have 1 to 20 again. That will give us 4,500. Then we have 20. That will give us 33,000. Okay. What are we going to
The
do?
discount factor, the annuity factor.
Yeah.
The annuity factor is 2.85.
2.85.
Yes.
2.850. Yeah.
Okay. What will be the discount factor for?
The value is 12,825.
12,825. Okay. And
0.0025.
0.0025. Then 35% is too big. But let's move on. Since you are getting negative, no problem. 0.00.
Yes.
0025.
Okay. If you multiply, what are you getting? So just make it 0.03. Okay.
82.5.
82.5. Let's use 30. That is the negative is too big. But if you use a 35, no problem. You will still be getting the negative, but just that is too, the negative is too big. Okay.
The discount factor is 0.005.
Okay, 0.053.
0.53.
The annuity factor is 3.316.
3.316. Okay.
So we have 165. The value of the discounted factor.
Okay.
165.
So this will be 165, and this will be what?
14922.
Okay. 149.
22.
220.
Minus 11913.
Okay.
11,913.
11,000.
900.
Okay. The negative. Okay.
913.
Okay. 913. Okay. So it means that even if you pick maybe 20 or 25, you'll still be getting negative. There's no problem with that.
75 will be okay.
Okay. But if you are getting negative, it doesn't matter. All of you will be getting the same. You'll be getting approximate what internal rate of return. They are not going to be getting, or they are not going to be using the same. We are all using a guess rate, so there is no way they will be saying that students should, as soon as you are using two rates and they are giving you positive and negative, there is no problem with that. So let's come to the internal rate of return. We have the what?
10%.
The lowest rate. So let's just write that at once. So we have the 10% plus the NPV of the positive one is what? 16.
16,230.
Okay. Divided by 16,230 plus 11,913 multiplied by 30%. minus what? 10%. Is that correct?
Yeah.
Okay. So our internal rate of return will be 10% plus
Plus 11.53.
percent, isn't it?
Yes.
You get 21.53%.
Okay, 11.53%. So this will give you 21.53 what? Percent. So that is your cost of the preference shares. Okay, if it is redeemable, this is what we do. If it is irredeemable, we just find the dividend over the 27 million multiplied by 100. The dividend divided by the price net of issue cost multiplied by 100 if it is irredeemable. But this one, they are saying that it is what? It is redeemable. So we use the redeemable option. Okay, let's come to the second one, which the shares are issued at premium. What I'll do is I will just show you how you can go about this one. So if the shares are issued at a premium, shares are issued at a premium, so we look at the value. So let's look at the par value of the shares. So the par value will be the 300,000 multiplied by the 100 cedis. Okay. How much are we having? We are having 30 million, isn't it?
Yes.
Okay. If they are issued at a premium, what will now be the total value? If they are issued at a premium.
300 by 110.
Okay. So if they are
300 by 110.
If they are issued at a premium, it means that we are going to be getting 10% in addition to the amount that we are currently having. So for you to find that, it's just the 1.1 multiplied by the 30 million. Okay. You'll be getting 33 million. Okay. Then you now find your current value net of issue cost. So that will just give you 33 million minus the 3 million. So you now have 30 million as the value. Then if you count your years, you count your cash flow, you count your discount factor, you count your PV, your year zero will be the 30 million, which will give us 30,000. Then we have the 30,000 here. Your dividend will still be 4,500. Then you can still use the same rate that you have used. Maybe you can still start with the 10%. Okay. You can still start with the 10%. So you'll be having 8.514. Then you count to this one. You'll still be having, this will still be redeemed it will still be redeemed at a premium. So you have your 33,000, and that will be giving you 0.149. So you find your value, and that is it. Then you come to the next one, you still do the same thing. If it is issued at a discount, it means that we are only going to be getting 90% of the issue amount. So if it is issued at a discount, it means that you have given 10% to the people. So you only be getting 90% of the amount. So the discount amount will be 90% of this, which will be 27 million. Then you still come and subtract the issue cost from it. That is the current value. Then you still do the cost of the debt using the redeemable one. So there is no problem with that particular issue also over there. Okay, we are getting closer to the low side. Let's look at the question number 2. Auntie Patricia.
Question 2. The equity beta of Fence Company is 0.9, and the company has issued 10 million ordinary shares. The market value of each ordinary share is 7.5 Ghana cedis. The company is also financed by 7% bonds with a nominal value of 100 Ghana cedis per bond. Each will be redeemed in 7 years' time at nominal value. The bond have a total nominal value value of 14 million. Interest bond has just been paid, and the current market value of bond is 107.414 Ghana cedis. Fensco plans to invest in a project which is different to its existing market operation and has identified the company in the same business area as the project Fensco. The company beta, the equity beta of Hensco is 1.2, and the company has an equity market value of 54 million. The market value of the debt of Hensco is 12 million Ghana cedis. The risk-free rate of return is 4% per year, and the average return on the stock market is 11% per year. Both companies pay corporate tax at a rate of 20% per year. Required: calculate the current weighted average cost of capital of Fensco. B. Calculate the cost of equity which could be used in appraising the new project. Explain the difference between systematic and unsystematic risk in relation to portfolio theory and the current asset pricing model.
Okay. Don't worry, it is normal. I just feel that you are not feeling well, you are tired or whatever be the case. Don't worry, you'll be very fine. After first week in July, everything will be okay. We all be fine. Okay. So yes, let's come here. You see, you can see that the company is planning to enter into the company want to undertake a project that is unsimilar to their operation. Okay. Whenever that particular thing is being said in the question, you have to know that you are going to be doing what we call the ungearing and all those issues with the regearing and everything. Okay. But let's come here. Currently, the company is having something over here and they are asking us to find the current weighted average cost of capital of the entity. So what is their current weighted average cost of capital? What is the current one? Before we even talk about the investment, what is their existing weighted average cost of capital? That's what they are asking us. Okay. How do we find please, you cannot find weighted average cost of capital without knowing your cost of equity and also your cost of debt. And sometimes they can also give you preference shares. Weighted average cost of capital is calculated on the existing capital structure of the entity. So if the entity is having preference shares, you have to include the preference shares in their capital structure. If they have bank loan, which is a long term, the bank loan has to be factored into the capital structure. But what we are doing over here is just the debt. If you're having preference shares and you also have debt instrument or bond, preference shares to be treated differently from the bond. Why? Because the bond will be tax deductible, but the preference shares are not tax deductible. So you cannot combine them as cost of debt. No. So preference shares has to be cost of preference shares has to be calculated separately, and the cost of the debt has to also be calculated separately. Okay, so let's come to this one. Our WACC will be calculated as the VE over VE plus VD, which will always be on market value basis, multiplied by, so let me write this one before, multiplied by the KE, which is cost of equity. Then I will now factor in, so I'll try to use some illustration to demonstrate why preference shares or other ones can be included there, plus your VD over VE plus VD, okay, multiplied by KD. Why KD? Because we are going to be bringing after tax cost of debt. So if you are bringing pre-tax cost of debt, that's why we have the 1 minus the T. Okay, so let me come now here. If we have preference shares, if you have the preference shares in our solution, let's assume that our value of equity. For example, it is not part of what we are doing. Okay, we have our current value of equity to be, let's say it is 200 million. Okay, and the cost of equity, let's say, is 10%. Okay, let's say our current value of the debt is 150 million, and our cost of debt after tax is, let's say, is 8%. Then the question can also give you a value of preference shares. Okay, let's say the preference shares is 100 million, and the cost of preference shares, let's say, is 5%. So the cost of preference shares is 5%. Okay. Please, the WACC is always calculated on, we want to know the cost of our existing capital, the capital structure. We want to know the cost. Okay. If you want to know the cost, this is how you are going to be calculating the cost if you have preference shares, or if you have bank loan, which is a long-term source of finance, or which is a long-term debt, or a long-term capital. We also factor in. This is how we are going to be factoring this. Okay. What will be our return? What will be, in terms of money, what will be our cost of equity in terms of value, not percentage? What will be the cost of equity in terms of value?
200 million.
No, in terms
200 million, yeah.
No, cost of equity.
So it's 2,000. 20 million.
Okay.
20 million.
20 million. What will be our cost of debt in terms of value?
12.
Okay. What will be our cost of preference shares in terms of money?
0.05.
No, let's make it 100 million. Let's make this 100 million.
5.
Okay. So what will be the total return that we are going to be paying? That will be 37, isn't it?
Yeah.
Okay. On a total amount of what?
$450 million.
Okay. So what will be our WACC? WACC will be 37 over 450. Okay. Then I will now modify, if you want to use the formula, I will now modify the formula for you. I'm getting 8.2.
Yes.
Okay. So let me now write this in formula for you. If
Yes.
you use formula, this is what you'll be doing. If you want to use formula now, if you want to use a formula, this is what you will be doing. Okay. This is the same thing that we are writing here. Okay, look at this one. We have 20. This will be the same as 20 divided by 200 plus 150 plus 100. Okay. Then we have multiply by the 10%. Then we have 200 there plus
0.1.
okay, 150 divided by 200 plus 150 plus 100 multiplied by 8%, isn't it? Okay. Then we have plus the 100, which will be the preference share, divided by 150 divided by 150 plus 100. Okay. Look at this. Can you say that this is the same as 0.1 multiplied by 200 divided by 450? The first one.
Yes.
Can we say that?
Yes.
Okay.
Yes.
Can we also say that this is 0.08 divided by
150.
multiplied by 150 divided by 450, isn't it?
Yeah.
Okay. Plus this multiplied by 5%. So this will also be 0.05 multiplied by 100 divided by 450, isn't it? Okay. What can we see over here? We can see that the denominators are the same, isn't it? Okay. If the denominators are the same, we can say this is 0.1 multiplied by 200 plus 0.08 multiplied by 150 plus 0.05 multiplied by 100, all divided by 450. Okay, you can see that the first thing that we have calculated is the same as the formula that they are using. Okay, so you can break the formula down to just the total return divided by the total capital. This is the same thing that we have done, which was 20 plus the 20 plus the 10 plus the 7 that we have done. It's the same thing that they have done in the formula form like this. So if you are doing formula, it means that you have to incorporate your preference shares now into this particular formula by adding it to this one. Or you can find the return on their current values divided by the total current value multiplied by 100. That can also give you the work. Okay, so you don't have to memorize the formula and go to the exam hall. Just understand why they are getting that figure. That is all. You are good to go. You can go to the exam hall without having anything in your mind. So we need to find our value of equity, which is the current value of equity for our current work. Okay. The company, the equity beta of Fen School is what? 0.9, and the company has issued 10 million ordinary shares. The market value of each ordinary share is 7.5. So if we are issuing 10 million shares and the shares are currently trading at 7.5, what will be the total current value of the shares?
$75 million.
Okay, that will be 7.5 multiplied by 10 million. Okay, that will give us 75 million. Okay, the next thing is that we need to find the cost of equity, isn't it? Okay, the cost of equity now, which of the methods that we can use? Can we use dividends over here, or we can use CAPM?
CAPM.
Okay, so let's use CAPM over here. Using the CAPM, we have the cost of equity is equal to risk-free plus the equity beta into bracket the return on the market minus the what. So sometimes the question can give you the market risk premium. The market risk premium is the difference between the return on the market and the risk-free. If you are investing in a government security, risk-free is always the government security, so that they can give you a treasury bill. So the treasury bill will be seen as what? A risk-free. So the government securities, whether you like it, forget about the recent haircuts. Okay, whatever is going to be happening, they will pay you. So it's risk-free. You are not going to be losing your amount of money. Okay, but if you are investing in what? In a private security, there's a possibility that you might be losing your investment. So they are going to be giving you a higher return than what the government will be offering you. The difference between the two rates is what we call the market risk premium or the equity risk premium. Okay, so they can give you the risk premium. It's just the difference between these two. You put it there. Okay, let's come to the current risk-free rate of the entity is what? What is the risk-free rate?
4%.
Is it 4? Okay, 4. That is 4%. So we have the 4%. The beta is what? Equity beta is what? Equity beta of French school is what?
0.9.
Okay. Equity beta of French school.
0.9.
Okay. 0.9. The return on the market is what?
11%.
Okay, 11%. And the risk-free is 4%, isn't it? Okay. So we have 4%, 0.9 multiplied by 7%. What are we getting?
10.3%.
Is what?
10.3%.
10.3%.
7.3.
10.
10.3%.
Okay. So we have 10.3%. Okay. So we need to now know the value of debt. Okay, we need to know the current value of debt. The current value of debt. Okay. This is another way of finding the company is currently having what? Okay, the company is
7%
also
bonds.
okay. The company is also financed. The company is also financed by 7% bonds with a nominal value of 100 cedis per bond, which will be redeemed in what? In
7 years'
7 years'
time.
time at a nominal value. The bonds have a total nominal value of 40 million. Interest on the bond has just been paid, and the current market value of the bond is 107.14. Okay, we say that bonds are issued in a unit, isn't it? And each unit is
Yes.
how much?
100.
Okay, so it means that the total amount that you are receiving from the bond is 14 million, isn't it?
Yeah.
Okay, the question is, how many units have you issued at 100 before receiving the what? The 14 million. So you find the number of units that you have issued, which will give you your 14 million divided by the 100 cities. Okay, then you now multiply by the current value, which is 104. Okay, so you find the number of units that has been issued. The 14 million given to you is a nominal value, which the unit has been issued at 100 cities. So how many units has been issued? Now, the current market value is 107.14. So the current market value has to be the number of units that you have multiplied by the current market value, which is what? 14 million divided by 100, or which can also be calculated as your 107.14 divided by the nominal value multiplied by the total nominal value of 14 million. So you can do the current value over the nominal value, which are all going to be per unit, multiplied by your existing nominal value. You have to be getting the same answer for all of them. How much are we getting?
14,999,600.
Can we make it 15 million?
Okay.
Okay. So let's come to now the cost of debts. The cost of debts now, what do we have to do? It is redeemable, isn't it?
So we find the IRR.
Okay, so we have to now find the RR. Okay, finding the RR, what do we need? We need a current market value. So we need a current market value for the RR. We need a current market value. We need a current market value of 107.14. We need the interest, but the interest should be after tax interest. So we need after tax interest. So after tax interest, okay, after tax interest will be what? What is the tax rate?
20.
So what will be the after tax rate?
0.8, 80%.
Okay. So that will be 0.8 multiplied by, what is the interest rate? What is the nominal rate?
7%.
7% on how much?
100.
It's 5.6%.
7% will always be, the interest will always be paid on the what? On the nominal value. Okay. If you are given an amount of, or you are issuing a bond of 100 cedis, the interest will be paid on 100 cedis, but you just want to value using market values. So the interest will always be charged. We are calculating this on unit basis, so it will be charged on 100. How much are we getting?
5.6.
So we have 5.6. Okay. Then we also, what do we need again? We need a current market value. We need a what? Interest, which is the inflow, and we also need a redemption value. Okay. The redemption will be done at what? Par. I said redemption will be done at par, isn't it?
Yes, the nominal value, at the nominal value.
So at nominal value will still be the 100. But if you are using total values, your 6% will be calculated on 14 million, and your redemption value will be what? 14 million, and your market value will be 15 million if you are doing it on total basis. But it is always advisable to do it on unit basis. So let's calculate this one. Now we have the years, we have the cash flow, we have the discount factor, then we have the PV. The discount factor, you are just using the guess rate. You are using any rate that will give you positive, and any radar will give you negative. So you can always start with a 10%. Okay, we have the year zero, which is now. Now is the year zero. We assume that all cash flows are going to be arising at the end of the year. So if you are paying that particular amount of money now, it means that that is the now. Okay. Yes, Nakafi, I saw your hand up.
Yeah, it's like we are not done finding the cost of debt.
The cost of debt is what we are coming to look for.
Okay.
Yeah. So our current market value will be 107.14. Then a discount factor will be this one. We have 107.14. Okay. The interest will be paid for how many years?
7.
Okay.
1 to 7.
So that will be 1 to 7 annuity. 1 to 7. So that will be 5.6, isn't it? And at the end of the 7
Yeah.
years, we are going to be redeeming at 100. Let's find the discount factors fast. And we
Annuity is 4.868.
4.868. Please, it should always be to 3 decimal places. Hey, I didn't share the formula sheet with you. Sorry.
W
0.513.
0.513. Sorry. Hey. Oh, no. Tomorrow I'll try to get it. So what will be the values? 5.6 multiplied by 4.868. I'm getting 27.6, 27.26.
26. Yeah.
Okay, 27.26. Okay, this will be 51.3.
Yes.
What are we getting?
51.3.
Okay, so if you, what are we going to be getting?
Minus 28.5.
28 point what? 58. Okay. So right
negative.
now, okay, negative. Right now, if 10% is giving us negative, what do we do? The next rate should be what? Higher or low?
Low. Lower.
Okay. So if it is low now, what rate are you going to be picking? 5% or what?
2%.
We should pick.
3%.
Okay, let's try 2 or 3. Okay. So let's try 3 and see. So we still have the years, the same cash flows that we are going to be using, but the discount factor will be different. So we have the cash flows, we have the discount factor, let's use 2%. Then we now have the PV. So the year will be 0 now. We have 107.14. Then we have 1.00, 107.14. So we have 1 to 7, that will be 5.6. Then we have 7, that will be 100. So let's find them one by one and see.
So annuity will be 6.472.
Okay, 6.472.
0.871.
0.871. So this will be 87.
And the top one will be 36.24.
So 36.24. Okay.
So you are getting positive 16.2.
Okay. So positive 16.2. So our cost of debt, which is the IRR, will be 2% plus 16.2 divided by 16.2 plus 28.58 multiplied by 10 minus 2, all percent. Please, you do this one first before you add it to the 2%. So KD is equal to, what are we having? I saw two hands up.
I wanted to ask,
Point.
should it always be positive?
Yeah. Is it what always the what?
I'm asking the A, should it always be positive?
We are just using two rates, okay? So one of them should be positive, one of them should give you a positive NPV, one of them should give you a negative. So anyhow you want to name it. If you want to name it A, if you want to name it B, there's no problem with that. Okay, but the first one should always be the first one that will come will be the rate, the discount factor that we have used to get the negative NPV. Okay, so if you want to name it A, you want to name it B, there's no problem with that. But you just have to use two rates. That is, one of them should give you negative NPV, one of them should give you a positive NPV. And the rate that will come first will always be the discount factor that is giving you the positive NPV. Please, are you okay?
So the total will be 4.7%.
4 points.
9. Right.
Hey, someone is saying that 14 point something. Why is the person getting the 14 from?
4.8.
So 16.2 divided by 44.58 multiplied by 8. I'm getting 4.91.
So 4.9, yeah.
Okay. So let's make it 4.9%. So the person should check that one well. Okay, with this one now, we can now easily calculate our WACC. So we can now calculate our WACC. I will not use the formula again, but what I'll do is that let's look at this. We look at let's look at the capital. So let's look at the capital here. Let's look at the capital here. Let's look at the return. Okay. So let's look at the equity. Equity is what is the value of the equity? The market value of equity.
75.
Okay. But the cost of equity is what?
10.3.
Okay. So 10.3% of 75. What are we going to be getting?
$7.725.
Okay. So that will be 75%. And the return will be what? 7 points.
725.
725.
Okay. Let's come to debt. What is the current value of the debt? That is 15 million, isn't it?
Yeah.
Okay. Our cost of debt is what? 9%. So if you multiply, what are we getting? 0.049 multiplied by 15. I'm getting 0.735.
Yes.
Okay. So let's find the total. Would this be 90 million?
Yes.
And this will be what?
8.46.
Okay. 8.46. Okay. So what we do is that our WACC will now be calculated as 8.46 divided by 90 million multiplied by 100. What are we having?
9.4%.
9.4%. Okay. Okay. So that is their current weighted average cost of capital. Okay. Let's come to the second one. Calculate a cost of equity which could be used in appraising the new project. Okay, so we have to now talk about a new project. They say First School plans to invest in a project which is different to its existing business operations and has identified a company in the same business area as the project, which is the Hen School. The equity beta of Hen School is 1.25, and the company has equity market value of 54 million. The market value of the debt of Hen School is also 12 million. The risk-free rate of return is 4% per year, and the average return on the stock market is 11%. Both companies pay corporation tax at a rate of 20%. Okay. The First School is in a different industry, isn't it?
Yeah.
Okay. And they want to carry out a project in a different industry. Okay. The operational risks of these two industries are going to be different, isn't it?
Yes.
Okay. So we cannot use our existing cost of capital to appraise what this particular project, because this particular project is coming with a different operational risks. Although we might be using the same capital structure to finance them, so the financial risk must be the same as the financial risks that we are facing. We can use equity and debt, but this project is going to be having a different business risks or operational risks. So we need to now find the business risks of the industry that we want to enter in, the industry one or the area that we want to undertake this project in. So what we normally do is that we look for a company that is already operating in the industry that we want to undertake the project, So that particular company, we use their financials to determine the operational risks, which we call the asset beta of that particular industry. So we find the asset beta of that particular industry by using the financials of a company that we call a proxy company, a company that is already operating in that particular industry. We use their financials to find the asset beta, which represent the operational risks. Then we now use the operational risks and now incorporate our financial risks into it and get what we call the equity beta. So we'll be looking at a company that is already operating there, which we call the Hen School. Okay, what is the Hen School? Okay, the Hen School, we need to use the financials of Hen School to find what we call the asset beta. Okay, and the asset beta represents what we call the operational risks of the entity that we want to enter. As soon as we know the risks over there, okay, this, if you want to operate in that particular industry, this is the risk. Okay, if we want to finance this particular project, this is the risks associated with the capital structure or the money what we want to use. So what will be the total risk? That's what we call the equity beta. How do we find the asset beta? The asset beta is just calculated like how we calculate our WACC. But what happens is that we factor in the tax elements into the proxy company. Okay, so what we do is that you have your value, equity value, which will be market value, divided by this one, okay, into brackets 1 minus t, then you multiply by the equity beta of this particular one, then plus the debt component, but we assume that the debt is risk-free, so the beta factor of the debt will be 0. So if you multiply everything, it will be 0. So you always be seeing something like this. So we can include the debt, but we always assume that the debt is having a risk-free. So the beta factor on the debt is 0. So you multiply everything by 0 will give you 0. All right. So let's now go. We'll be using the financials of what? Of Hen School. We want to know the asset beta, which represent the operational risks of the industry that we want to undertake the project in. So let's go to Hen School. Let's use their financials now to find let's use their financials to now find the asset beta. Okay, their equity value is what? 54. That is 54. So their equity value. So asset beta, which is this one, their equity value is 54 divided by 54 plus what? What is their debt value? 12. And this one will be after tax. So this will be 0.8 because the tax is what? Is 20%. So what are we going to be having for that? What is their asset beta?
1.2.
So So we multiply
No,
this
the
by,
equity beta.
okay. So let's calculate those values now. 54 divided by what? Hmm. I'm getting 63.6 as a total.
Yeah.
Okay, so what would be the asset beta?
One 1.19.
Can we say is 1.02?
Yeah.
Okay, yeah, 1.02.
So this is the operational risks associated with operating in that particular industry. Okay, so this is just about the operational risks. Now we are coming to undertake the project. It means that we also have to now include our financial risks. So how are we going to be financing this project? So we have to now use their asset beta to now calculate our equity beta. Calculating our equity beta means that we have to now include our financial risks into this. So we now calculate this one for the company itself, which will be the fence school. So we calculate this for fence school. We now use this particular one to calculate the items for fence school. What do? We just interchange the formula, this formula. We just interchange the formula. So we have an asset beta, we are looking for equity beta. What do? We turn everything upside down. That is what we do. So our equity beta will be calculated as VE plus VD into bracket 1 minus T divided by VE multiplied by the asset beta calculated. The items that we use over here will be the company itself. So we now go and look for the items of this company. This will be 75 million plus their debt value of 15 million divided by 75 multiplied by the asset beta calculated. Okay, what are we going to be having? Okay, so our asset beta, our equity beta is equal to 87 over 75 multiplied by 1.02. What are we having?
1.18.
Okay, so we are having 1.18. This will now be the equity beta of the new project that we want to undertake. Then we use this one now to calculate the specific cost of equity using CAPM. So we now have the cost of equity by using the
Okay.
Yes, please.
And so the time we got the time we got the figure we got down there before coming to this side, and we just multiply by 1/54, so that maybe we get directly the 1.18. Is that allowed? Since we said it has an inverse, since we have the inverse relation, so maybe we multiply with 1/4 times the how to call this, the 1.02. 1.02 times 1/54.
Multiply by 1 over what?
The 1.02 times 1/54. Since you said we just turn it around at the fence school.
The fence score, if you are calculating, if you want to turn it down, you are going to be using the figures of fence score, not the figures of the other company.
Oh, okay.
Okay. Okay. So let's calculate our cost of this one. We now have the equity beta, then we have the return on the market multiplied by that. Then we now have the 4% given to you plus the new equity beta now, which is 1.18, which is the equity beta associated with that particular project. Then we have the risk-free was 11%. So you have 11% minus the 4%. So you'll be having your KE is equal to 4% plus 1.18 multiplied by 7%. In total, what are we having?
12.26%.
12.26. Okay. So this is the cost of capital that we have to use to appraise the new project. Explain the difference between systematic risks and unsystematic risks. What is the difference between systematic risks and unsystematic risks?
Salanos, go back to the bottom is something.
What is the difference between systematic risk and unsystematic risk?
Systematic risk are risks that are associated within a particular industry. And unsystematic risks are risks that are not associated within a particular industry.
Zina, do you think they are going to give you marks for this?
Industries. Example, interest rate, inflation. And unsystematic risks are risks that are specific to a particular company or organization or industry. Yeah.
I didn't hear the starting part.
Okay, so I said systematic risk are risks that affect all businesses. Yeah, so and they can't, yeah, they affect all businesses. Example is inflation.
Okay.
Yeah, and unsystematic risk are risks that affect a particular business or organization.
Okay. Okay. At least you have tried. At least you have
Hey,
tried.
I didn't try. Eh? Hey, women empowerment.
Okay, if we talk about a systematic risk, we are talking about the risks affecting the industry as a whole. Okay, every security that you're having in that particular industry, the risk is going to be affecting it. It doesn't matter the entity that you are going to be investing in. The risk is affecting all the security in that particular market. Okay, so if you come to with the example that I'll use, if you come to the Ghana Premier League, okay, we don't have sponsorship. So if you want to come and invest in a team, that particular lack of sponsorship for the Premier League is going to affect you. So we can say the lack of sponsorship for the Premier League is something that is going to affect all the teams or all the clubs that want to participate in the Premier League. But situation where the Ghana Premier League is having a sponsorship, but it's a specific club that is not having sponsorship. So it means that you can avoid that particular risk of not having sponsorship by investing in a different club that is having a sponsorship. The situation where whether you invest in Mediama or maybe Accra House of Folk or Kumasi Kotoko or something like that, whether you invest in any of them, the risk of the Premier League not having sponsorship is going to affect all the clubs. Okay, and this is a risk that might not be eliminated. You cannot easily eliminate it unless you don't want to make that particular investment. But if you want to make the investments where the risks can be eliminated, how do we eliminate the risks? You can avoid in investing that particular investment. You can also diversify your investment to other portfolios. So the risks that are affecting the industry or affecting all the organizations within the industry, that's what we call the systematic risks. And this is the risks that we consider when we are calculating the capping. But the risks that are unsystematic are risks that are affecting only a particular company or entity within the industry. And we can avoid that by not investing in that particular entity and taking our investment to other companies that are not affected by that. So systematic risks affect all the securities in the market, but unsystematic risks affect only securities of a particular entity. So systematic risks are industry specific, but unsystematic risks are entity what specific. If you put it like that too, they can actually give you something. Okay, let me talk about what we call aggressive security and also a defensive security. We always use the beta factor. They can ask you to differentiate between aggressive security and a defensive security. So we use a beta factor. Any security that is having a beta factor more than one is what we call aggressive security. Their risk is very high, and that is going to be aggressive, and people will be demanding for a higher cost or higher return. The security that is having 8 beta factor less than 1, but more than 0, we say that is a defensive security. So they can ask you to differentiate between those two. If you are asked, at least you can be able to see something about that. Let's come to business valuations. You always see a question which will be a calculation, and you always see a theory question that will be on mergers and acquisition. They can actually give you a question on mergers and acquisition. I've said that you can check the YouTube channel, you see a video on mergers and acquisition. You can see a question on mergers and acquisition as calculation. But in most cases, it's always on business valuation or the combination of the two. You can see question on mergers and acquisition, which will be asking you for maybe advantages of acquisition and merger over organic growth. Okay, or internal growth. The company want to expand. You want to expand. You don't want to go and do everything for yourself. You don't want to send your own asset there. You don't want to go and establish everything over there yourself. You want to go and merge with a company that is already operating there, or you want to go and acquire a company that's already operating there. You doing this is going to be giving you certain benefit over you doing everything yourself. So they can ask you about advantages that the acquisition is having over the internal growth, which we call the organic growth. If you are acquiring a company, it is going to be very simple, easy for you. You don't have to go and do everything there. The company is already there. So this is going to be sometimes very simple. It's easy. Okay, you can also have access to intangibles. The company will be having what? Employees or customer base that are a benefit to them, that is a good deal to them. So if you acquire those things, you are going to be acquiring these people also as part of the organization. Okay, you can also have access to what? A new market that a company will be if you want to do it yourself, you'll be struggling to enter. If you acquire a company in Nigeria, that particular company is already having customer base. As soon as you acquire them, it means that you now have access to their customer base. So you can also have access to overseas markets, which will be very difficult if you want to do it yourself. Which will be very difficult if you want to do it yourself. Sometimes too, it is also cost effective. Sometimes cost effective, and sometimes it can also be very expensive. Okay, so they can ask you about advantages. You should be able to say something over there. They can also ask you about disadvantages. Okay, and they can also ask you why mergers and acquisition fails to what? To achieve the desired result. If they are asking you that, they are asking you about the disadvantages of mergers and acquisition, where we have issues of integration problems. The two companies are using different organizational structure. So if you're having a different organizational structure, what is going to happen is that it will be very difficult for management to put this organization together as one. So we can also have integration problems. We can also have issues of acquisition premium. You are going to be paying more amounts for what is not worth that particular amount. And this is going to be giving you problems. You can also acquire what? You can also acquire obsolete assets that are not effective, but you are going to be acquiring them. Okay. And sometimes the company might not have the expertise to do whatever they have to do, or they don't have the expertise to run the new firm that they are operating. So they can also ask you about those ones. And the advantages they can also ask you the types of the integration that we have. We have the vertical measure and the horizontal measure. They can ask you about those ones. They can also ask you about defensive mechanisms that a company or management will use when there is a merger or there is a takeover. If you want to acquire or you want to merge with a company, the management might not want that particular acquisition or merger to happen or takeover to happen. So they will be using certain tactics to be able to delay or to be able to avoid that. They can ask you, and some of these things that we are going to be looking at. Okay. Yes, Ante, can you take that for us?
Question 1.
Yeah.
A. Explain the following terms as used in mergers and acquisitions. Poison pill, staggered board of directors, golden parachutes.
Okay. So poison pill. What do you mean by poison pill?
So it's where the target company, they sell their best fixed assets.
Okay.
Before they are.
Okay. So the poison pill is a situation where they will make the company, the management of the target company. The target company is the company that they want to acquire, which is the victim company. So the management of that particular company, you want to acquire the company because of maybe the asset that we have. So they can dispose of the productive asset and make the company looks unattractive to the acquirer or the predator company. So a situation where it's a defensive mechanism or tactics that they use where management will dispose of the productive asset of the company to make it unattractive to the predator company. That's what we call the poison pill. Okay. So you cannot come and purchase an asset that a company that is having old assets and all those things. They can dispose of the productive assets and they'll give you the company like that. If you like it, you can acquire. In most cases, you cannot acquire because the amount that you are going to be spending to put things in order will be a problem for you. Okay. The next one. Okay, the next one.
So it's where the targets, the management of the target company tries to convince the shareholders of the company that they have to so that they will not allow the target company to take.
Are you sure? Okay, the stage board of directors, that one we haven't done that one. Okay, so it's a new term that we have to explain. Yeah.
Senior.
Yes, please.
With that one, the board of directors make their tenures in such a way that while some of the directors are leaving, others are also around, making it difficult for the predators company to take over. The structure in such a way that while some of the old directors are leaving, new ones are coming. So there's no way all the directors can have their period ending at the same time in a manner to give opportunity to shareholders to allow any predator company to come in. So they always have a systems in place. Once somebody is retiring from the board next month, another person is coming in and all that.
Okay, the idea is there. The idea is there, but is there? Okay, the idea is actually there. Yes, Nakafi, you also want
Can we say it's a system that the board of directors create in a way that it looks as if there is a confusion between the board of directors.
No,
Yes,
no, not.
it's a strategy to prevent other people from acquiring the business, because once there is a confusion there, you cannot come to the company and then purchase it.
No, it's not actually about confusion. Okay.
Hello.
Yes, yeah.
Yeah, so let me also give it a try. So I think the stated board of directors is usually consists of a board where the directors are grouped into classes, like, and then each class has a tenure. So they are grouped into classes like, say, class A, class B, and let's say class A has a time or a tenure of 5 years and class B has a tenure of 10 years. So usually they are grouped into classes. The directors are grouped into classes.
Okay.
Yeah.
Okay. It's just like how you run shifts at work. Okay. So we have the board of directors, but we are not going to be allowing them to what to save on the board for a particular period. So what we are going to be doing is that what the management are going to be doing, they will have the board of directors, but these people will be grouped. Okay, they will be grouped now into maybe classes. Someone is in classes. They can be divided into groups, and each groups will be given a period that they are going to be saving on the board. So we can have like 5 groups, and it's just like they'll run a board like a shift. Okay, so since you are taking over from this particular board, we can have the group A now in what? Group A now saving the board, and you are now taking over. It means that when the tenure for group A is over, group B will come in. So they do it in such a way that it's very difficult for the predator company to have control over the board. So they will divide the board into groups, and these groups will be given a different period of tenure, or they will be given a different tenure, or they will be running the board in shifts based on how you do the work shifts. So this person will come this morning, this will come. What we do is that these people will be given a period. So if you are acquiring the company now and we have a board that will be saving for 3 years, after the 3 years, different board will come. And after that 3 years, different board will come again, because we have already appointed them and everything is being in place. So we do it in a such a way that the predator company cannot actually have control over the board. The predator company cannot actually have control over the operations of the company. So the target company, they will form a board. They will form a board, and this board, they are going to be having members over there. But the members will not be on the board, because you know that the board, if you're a member over there, you are going to be saving for a particular period. So after that particular period, that is the end for you. Maybe they have to reappoint you or something. But what they'll do is that they'll have the board. They can have a board of 20 people. So 5 people will be serving on the board. So they can give the first 5 people 4 years. After that first 4 years, the second batch will come for 4 years again. The third batch will come for 4 years again. Maybe the fourth batch will come for 4 years. And this will make it difficult for the predator company to have control over the board or to have control over the company. So they will have the board and they will divide the board. The board will be running in stages. That's what we call the staged board of directors. Okay, so Sinaiben, the idea was actually there, but how you are putting it is the poison pill. The poison pill, we are talking about a situation where management of the target company will sell off the productive asset to make the company look unattractive to whoever want to purchase or whoever want to take over or whoever want to merge with that particular company. So we only sell the productive assets off. So if they have productive asset, they will sell it off, and that is it. So the company will now look unattractive because there's nothing there you have to go and do, because if you are going there, you are going to be spending money. So they will sell off the productive asset. That is what we call the poison pill. Okay. The stage board too, the board is designed in such a way that if the acquisition is done, if the merger is done, you cannot have immediate control over the board. After the tenure of the first board, another board will come. So if the board are being arranged in groups, the board of directors they are already been appointed, and they have been given different tenures to run the board. So after the tenure of this one, another one will come. After that one, another will come. So they'll do it in such a way that it will prevent the predator company to have an instance control over the what? Over the board. Golden parachutes.
Senior.
Yeah.
Okay, so golden parachute is where management of the target company design hefty compensations for themselves to either make exiting difficult or serve as a cost to the acquiring company. Serve as a cost to acquiring company. So they design hefty compensations and salaries or exit packages for themselves.
Okay. I'm just praying that lady should not come and say something. Okay. Charge a higher sovereigns or redundancy. Okay, that's no problem. Okay. Do you have anyone on that?
Oh, say,
Yes, yeah.
I want to add to what he said. So with the golden parachute, the target, the target company designs higher compensation benefit for the senior management. So they propose that if you acquire the company, that is senior management are going to take this compensation benefit, let's say bonuses or salary rates. And in that case, it discourage the acquirer from trying the takeover bid.
Okay. The golden parachute is not the amount that the benefit that they are going to be charging is not about the continuity with the entity or with the organization. Okay, it's not about the continuity. If you are taking over or if you are merging, it is likely that some of the stars will be laid off, isn't it? Okay. If these
Yes.
people are being laid off, you need to pay them a certain amount of money, isn't it?
Yes.
Okay. So they can demand for what? They can demand for that a higher amount of money. Okay. If you are going to be taking over, there's no way a company will take over or a company will acquire and they will still want to maintain what? The same employees. They will come with their own team and everything. So if you are coming with your own team and you are going to making some of the employees redundant, this is the amount that you have to pay them. So they will charge a higher redundancy cost in case you want to sack them. And there's no way you are going to be acquiring a company without getting rid of some people. So they will demand for a higher severance what? Payment or redundancy payment. And this will be discouraging you to come and what? Because if you want to acquire the company, you are coming with your own people. You can say you want to replace management. If you are replacing management, this is the amount that the management say they are going to be taking. If you look at the amount given to them, if you look at the amount that you'll be giving to them, and the amount that you are going to be paying and the benefit that you'll be getting from the acquisition, you will say, no, they should just be there. That is all. So that's what we call the golden parachute, a situation where management will be demanding for higher severance payment or redundancy payment in case you want to acquire them and you want to acquire the company and lay some people off. This is the amount that you have to pay them. Okay, that is what we call the golden parachute. We also have the white knight and the other one. We go there. There's a question somewhere there. We go there and we look at it. Let's look at the B, which is about business valuation, and we see how we can go about this. Yes, Namensa.
Yes, sir. Sir, please, the poison pill, the explanation you gave, you said the management of the company sells the most valuable assets.
The productive ones.
Okay, so productive assets.
Yeah.
How is that different from selling crown jewels?
Selling,
Crown jewels.
which one is the crown jewels?
The crown jewels it's like a prey takeover defense where the company sells the most valuable assets they have so like they sell the most valuable assets. So when you come, there is nothing valuable you can use for your operations.
And the word is what?
So, crown jewels. Crown jewels.
Okay, I haven't heard. Then I have to go and look for it because this is my first time of
Okay.
hearing that particular word. So you can put it in the comment section. Maybe I'll go and look for it. I haven't heard about the crown. What's crown? I haven't heard about that one before. Okay, so maybe I have to go and read about it. All right. Let's come to the B.
B.
Oh.
Duet Limited is considering a takeover bid for Small Limited, another company in the same industry. Small Limited is expected to have earnings next year of 129 Ghana cedis, 129 million Ghana cedis. If Duet Limited acquires Small Limited, the expected results from Small Limited will be as follows. So we have the year and then the year 1, year 2, and year 3. So sales, cash costs or expenses, capital allowance, interest charges, and capital investments. Additional information. From year 4 onwards, it is expected that the annual free cash flow from Small Limited will increase by 4% each year in perpetuity. 2. Tax is payable at the rate of 30%. Tax is paid in the same year it falls due. If Duet Limited acquires Small Limited, it estimates that gearing after the acquisition will be 35%, measured as the value of its debt capital as proportion of total equity plus debt. 4. The cost of debt is 7.4% before tax. Duet Limited has an equity beta of 1.6. 5. The risk-free rate of return is 6% and the return on the market portfolio is 11%. Required. Sir, please, can you required? The offer price for Small Limited, assuming Duet Limited chooses to value Small Limited on the forward price earnings PE multiple of 8 times. B. The cost of capital of Duet Limited. C. Determine the offer price for Small Limited using discounted free cash flow valuation method.
Oh, okay. Let's see. Okay. So if you see the question like this, what is there that you can do about this question? What is the thing over there? The requirements. Which of them can you do straightforward? Or assuming you have seen this question, which one are you going to be trying first?
C.
The
B.
the cost of capital, isn't it?
Yes.
But the price earning ratio is the easiest one. The price earning ratio is the easiest one. Okay. They are even asking you to calculate this one. They are asking you to the offer price for Small Limited, assuming the Duet Limited chooses to value Small Limited on a forward price earnings, which is what the PE of multiple of 8 times. So what is their price earning ratio here? What is their earnings for the Small Limited?
129.
Which will be next year, isn't it?
Yes.
Yes.
Okay. Mostly we use the current earnings, but the question is saying that they are choosing forward what?
Earnings price.
Forward price earnings.
Okay, so we are using the forward earnings. So using the forward earnings, what we try to do is, okay, we can calculate the what? The price using the next year's what? Earnings. That's what they mean by the forward earnings. Okay, that's what they say, the forward earnings. Or they can also give you the earnings growth rate. They can give you the earnings growth rate. So you can try to present value this one to today's term, because this is next year. So you can find today's value. But they are saying you should calculate it on forward earnings. So you calculate it as if you are doing this valuation in the next year. So you just use the 129 there as the forward earnings. That is what they are asking you to do. So you just calculate that one, very simple. That is the first one that you have to do. Okay, so okay, so let's calculate the question number 1B. Let's look at the value of small limited using the price earning ratio. So we know that the price earning ratio is calculated as the market value over the earnings per share. But this one, they are asking you for value, the value that they have to offer. So they are looking for the total value. So what you do over here is that you use the total earnings or the profit after tax, which will be the total earnings. Okay, so you can use the total earnings here, which can be the profit after tax, because they are asking for total, not value of a share. So us looking at the market value can be calculated as, so we just play with the formula. We have the price earning ratio multiplied by the earnings that is given to us. Okay, what is the price earning ratio? 8 multiplied by the earnings of how much?
129 million.
Okay, so that will give us 129 million. But is small limited, are they listed? Okay, the small limited, nothing has been given about their listed. So if nothing has been given, you just have to adjust this one by, so I'm having 1032 million, isn't it?
Yes.
So you assume that this company is not listed and you adjust the rate by 20%. You reduce it by 20%. Reducing it by 20% means that you can multiply by 80%. How much are we offering for them?
$825.6.
Okay, so that is the forward earnings basis. Okay, that is the forward earnings basis. We don't have to.
Please, sorry. Please, what did you say the 0.8 was?
The 0.8 is an adjustment to the market value. The company that we are valuing is not listed. So you cannot be having the same market value or the same value as a company that is listed. So we always reduce the price by 20% or 25%. So if you reduce by, it means that you will now have 80% of the value that will be given to them. So reducing it by 20% means that you have to subtract 20% from the total amount. So you just have to adjust by the 80%, which is the 100% net of the 20% reduction. All right. Let's see whether we can calculate the, let's see if we can. Let's see if we can try the cost of what? The cost of debt. The cost of capital that they are talking about, not cost of debt. The cost of capital that they are talking about. Which one do you think they are talking about?
What?
They are talking about WACC, because you are giving information on equity and debt. So they are talking about WACC. Okay, they are talking about WACC. So the question now is, they are saying that if Diot Limited acquires Small Limited, it estimates that the gearing after acquisition will be 35%, measured as the value of its debt capital as proportion of the total equity. So what they are saying is that if you have your total capital structure of 35%, debt is what? 35%. And the equity portion will be 65%. So it's just the capital structure that is given to you. So debt is 35 and equity will be 65. Okay. And the cost of capital that they are asking you over here should be after acquisition cost of capital, because we are not giving pre-acquisition information on pre-acquisition items. So we'll be looking for our cost of equity. We'll be looking for our cost of debt. Then we now use them to find our WACC, which is going to be very simple. The other side is the what you have to think is the C side. Okay. So let's come to the C side, which will be the WACC. Okay. So the WACC, we can decide to use the VE.
Yeah,
Yes, please.
the work is rather BO, not C.
Okay, so we have VE, VD multiplied by the cost of equity plus.
So the first one is A. So you can change it.
No, it's question 1B. So the first one will be BA.
So we have the VE, VD, okay, multiplied by KD. So for this one, they have given us a VE already. What is a VE? What is the value of the VE?
Value.
65%.
Okay. So VE is a 65%. Okay. So we need to find the cost of equity. Cost of equity, what are we going to be using?
CAPM.
Okay. So we can use the CAPM there. Big equity beta return my over this one. So can we get, what is our risk-free?
6%.
Okay, we have 6%. So we have 6% plus equity beta is 1.6.
1.6.
Okay, return on the market is what?
11.
11.
Okay, 11 minus 6, all percent. So we can have 6% plus 1.6 multiplied by 5%. What are we having?
14%.
Oh, the total is 14.
Yes.
Okay. Can we find our value? Value is 35, isn't it?
Yeah.
Debt is 35. So can we find the cost of debt now? Okay. They are giving you cost of debt before tax, isn't it?
Yeah.
Yes.
So what do we do?
We find out that that's what.
Okay. So you just multiply. You just have 1 minus the T. One of the T multiplied by what? 1 minus T multiplied by
7.4.
okay, the pre-tax cost of debt. So what is the tax rate?
30.
It's
7.4.
The tax rate is 30, so we can have the into brackets 1 minus 0.3 multiplied by 7.4%. What are we having?
5.18.
5.18. So this one will be 5.18.
Yes.
Okay, let's make it 5.2. Okay, so let's go to, so by this one, why would I put this question there, which is not difficult?
Hey, it's not difficult, eh?
The cost of capital is not difficult. Okay, I was thinking, I didn't read the question very well. I was thinking you have to do a lot of things. Okay, maybe that statement can also be a problem. Okay, if George acquires Small Limited, it estimated that the gearing after acquisition will be 35%, measured as the value of each debt as a proportionate of the total equity plus what? Plus debt. So out of the 100, we are going to be having so let's have our WACC now. So the WACC will be 65. Can we just make it straightforward, 0.65?
Yeah.
Okay, 0.65 multiplied by the 14%. Okay, plus 0.35.
5.2.
Okay, 5.2. Okay,
%10.92%.
the total.
Yes.
$10.92.
Yes.
Okay, so that is the cost of the company that they are talking about. They are just talking about a WACC. It's not a big deal. Okay, let's come to the problem itself. Okay, let's come to the problem itself. Okay, determine the offer price for Small Limited using discounted free cash flow valuation was method. Okay, this is not the question now is, what do we call the free cash flow? Okay, you see what you'll be calculating and be calling it the NPV. The NPV is what we call the free cash flow. So what will be the cash flow after taking care of the investment that you are making? So if you are buying a particular item you are buying it for 10,000, at the end of the day, you are getting a cash profit of 14,000. What will be the free cash flow? The free cash flow is what is the cash flow after you taking out the cost from it. So what will be the cash flow after you have taken the cost of 10,000? The remaining 4,000 is what we call the free cash flow. So the free cash flow is just a cash flow minus the investment that you are making for that particular year. So how do we calculate the free cash flow for all of them? So we do look at the free cash flow for these ones now, and we now do the discounting. So we have the free cash flow. Let's come to year 1, year 2, year 3, and year 4. We do that one later. Okay, let's come here. You don't have to struggle. Okay, you don't have to struggle over here. You can pick the cells for each of the years, or you can just pick your contribution. You can find contribution for all of them, but if you want to show the workings for all of them, that's no problem. So we can pick our cells for each of them. What is the cells for each of these years?
300 million. 300 million, 420, and 480.
So we have 300,000. We are keeping 3 zeros, 300,000. And what?
420,000.
420 and what?
480,000.
480.
Okay. What is the cost?
180,000,
180,000,
240,000, and
180,
270,000. 180, 240, and 270.
and 270. Okay, what will be our
120,
okay? So let's look at
180,
120,
180, and
180,
210.
and 210, isn't it?
Yes.
Okay. So what will happen? They are giving us capital allowance, isn't it? So the capital
yeah,
allowance,
line up.
yes, please.
But that one will be your contribution. Then you are writing profit after tax.
They are giving you operating cost. The operating cost, it can be including your fixed cost. Okay. They just give you cost, and the cost can be fixed cost or
So that one will be profit before interest and tax, right?
sorry, not profit after tax. Okay. So let's see, this is cash profits. Okay. They are giving us capital allowance. The capital allowance is the one given to us by the tax authority. So this is going to be reducing our tax liability. So we have two ways of doing this. You can find the tax benefit, or you can subtract the capital allowance first and charge your tax and come and add your capital allowance back. So what is the capital allowance for?
We should just do after that. We come and bring the tax table.
What is the capital allowance for each year?
30, 45, 60.
Okay, 30, 45, 60. 45 and 60. How much are we getting?
90, 135, and then 70, 15. So
So let's come to our taxation. What is our tax rate?
30%.
So our tax rate will be 30%.
Yeah,
30% on 90,000, what are we getting?
27,000.
Okay, so we now have our 27,000 here.
But please, won't we consider the interest
The-
charges?
The interest is already considered in the cost of capital.
Okay.
The tax benefit on the interest is already captured in the cost of capital. That is what we always use after tax cost of capital. So it means that the impact has already been reflected in the cost of capital. So second year will be what?
40,500.
40,000.
500.
So we have 4,500.
And 4,500.
What are you saying?
The last one is 4,500.
How can 30% be on 650?
45,000.
Okay. Okay. So what are we getting? What are the after tax profits?
Okay, it's
The last
150.
one, 105.
The first one. The first one is what? I'm having 63,000.
63.
3.
The 94, 500.
Second one, 94, 500,000.
Okay, and the last
4,
one.
500. Last one, 105,000.
Okay, but these are profits because we have taken a depreciation out of it. We are looking for cash flow. So come and add the capital allowance back. Okay, the capital allowance will be 30,000 for this. Then we have 45,000 for this. Then we have 60,000 for this. This will give us 93,000. This will give us 139,500. And this will give us 165,000. Okay, so these are the cash flows. Okay, so they are asking for free cash flow. The question is, what was the capital investment for the first year?
55,500.
Okay, so if we take the capital asset, the cost that we incurred to generate this cash flow, if we take that particular cost out of it, what is the remaining cash flow? That's what we call the free cash flow. So the free cash flow is just like the NPV that you have been calculating. Okay, so let's come to capital investment one by one to know. So we take the capital investment over here to know our free cash flow. So this will be 55,500 for the first year.
94.57.
94. 500.
112,500.
112,500. So what will be the free cash flows?
37,500.
So we have the free cash flow to be 37,500.
45,000.
30.
45,000.
Okay, 45,000.
52,500.
52,500. So these are the free cash flows. So we just have to come and discount them. But there's something over here which they are saying that from year 4 onwards, it is expected that the annual free cash flow from small limited will increase by 4% each year in perpetuity. Okay, so we come and calculate that particular one too. But what we have to do now, are we giving the cost of capital for small limited?
No.
Okay, we are not giving
So
the cost of capital for small
we have to
limited.
use
So we use the cost of
IRR.
capital for the parent company. So the parent company, we know their cost of capital already. What is their cost of capital? What is the cost of capital for?
It was 4.
Yeah.
We calculated that
14.
one.
Yeah, 14.
No,
was
let-
10.92.
we need to use
Is
the
it the
WACC.
key or
Okay,
10.9.
let's use the WACC, or we can if you use the cost of equity too, there's no problem. But it will be very okay if you are using the WACC, because the WACC takes into consideration after the acquisition of the small limited, and these cash flows are cash flows that will be arising after the acquisition of the small limited. So what we do over here is that we are going to be using this particular one. So we have the cash flow, we have the years here, we have the cash flow, we have the discount factor, which will be 10.92. Then we have the present value. We have year 1, we have 37,500. We have year 2, which will be 45,000. We have year 3, and we have 52,500. That's something that we are coming to do. So these are the cash flows for the first 3 years. What are they saying? What are they saying for the year 4 up to infinity? What are they saying? What are,
from year 4 onwards, it's expected that the annual free cash flows from small limited will increase by 4% each year in perpetuity.
Okay. So what we do now is that what is the current year 3? What is the year 3? What is the value? What is the free cash flow for year 3?
52,500.
52,500.
Okay, they are saying that this will increase by 4% into perpetuity, isn't it? Okay. So we can estimate this particular value at the end of what? Year 3. We can estimate this at the end of year 3. Okay. So we can estimate this at the beginning of what? Year 4. Okay. So we have to know that, okay, our cash flow in year 4. What will be our cash flow in year 4? Our cash flow in year 4 will be increasing by 4%. So we can calculate the cash flow in year 4 to be cash flow in year 4 up to infinity. That will be the 52,500 multiplied by 1.04. Is that correct?
Yes.
Okay. If you want to find this in year 4, which will be done in year 3, we can say that this will be calculated as, so let's calculate, if you are calculating the present value of, so let's do the present value of perpetuity, that will be calculated as the cash flow itself divided by the discount factor minus what? The growth. Okay. We are going to be doing this for year 4. And the year 4 cash flow, we assume that the cash flows are going to be arising at the end of every year. So year 4 will be 52,500 into bracket 1.04 divided by 0.192 minus 0.04. Do we agree to that?
Yes.
Okay. So the top will be what? 52,500 multiplied by 1.04. I'm getting
54,600.
54,600.
Okay. Divided by the down will give us what? 0.0692. Is that correct?
You get 78,9017.34.
Are you sure?
The
54.
final answer. That's what he said.
Okay. 789017, isn't it?
Yeah.
0.3. Yeah.
Okay. 5,200. 5,200 divided by 0.07. Okay, let's change the, I want to get accurate figure. Let's change the cost of capital to 11%. Let's approximate this one to give it 11%. Okay. I want to get, okay, so let's have 11%. So this will be 0.11. And this will be 0.07. What are we having?
780,000.
Okay. So let's have 750,000. This 750,000, when are we?
80.
5, 4, 6,
780.
okay. Okay, 780. When are we determining this particular figure? In which year are we doing this?
The beginning of year 4.
Yeah.
At the beginning of year 4, isn't it?
Yeah.
Which is the same as what?
At
The end of year 3.
End of year 3.
So you can add that particular value here. We are doing this in today's term. So if we are doing this at the end of year 3, it means that this will be a cash flow arising from year 3. So you can add it to this one, or you can bring year 3 also over here again. So you can bring year 3 over here and have your 780,000 here. So let's find our discount factor one by one for each of these years. So 1 divided by 1.11. I'm getting 0.901 the first year.
Zero 0.812.
0.812.
812.
Okay.
0.731.
0.731. And this will also be
0.659.
Relax.
Yeah, correct.
Okay. So what are the figures that you are getting?
Year 3. No, year 4. Okay.
787.5.
7.
The year 133, 787.5.
Okay.
Yes.
Year 3. Last year 3. 5701.
36540.
Okay. 36.
Year 2, 36540.
Okay.
The last year 3 is 570180.
Relax. I'll come there. So yeah.
Yeah. Okay.
Okay. Okay.
570. 180. 570.
Okay. So you put all of them together. If the company want to pay, or the company want to now pay on the benefit. So if we are acquiring, what is the benefit that we are going to be getting? What is the benefit that we are going to be getting? These are the benefits. So we can just present value all the benefits and say, okay, this is the amount that we are going to be paying for the company. So the only problem is how to determine the free cash flow. The free cash flow is the cash flow after every expenditure that is being made to generate that particular cash flow. So it's just like the NPV, how we find the NPV. So you do it for every year. So you do the cash flow. Please never include the interest in determining your cash flow, because the interest, the interest impact is already incorporated when we are calculating what. So you can see that what is happening over here. Our actual cost of capital should have been what? 7.4 for the debt, isn't it? Our actual cost of capital should have been 7.4 for the debt. Is that the case?
Yes.
Okay, but we have now made it what? 5.2. Why 5.2? Because we have taken the interest effect from it. So the interest effect has been what? Has been adjusted against that. Unless the company, or the question is saying that you should use pre-tax cost of debt. If you should use pre-tax cost of debt, then it means that you cannot factor in the interest. If you're using after-tax cost of debt, it means that the interest, the effect of the interest has already been adjusted against your cost of capital. So you bringing the interest again will be a double charge on that particular item. Okay.
Hello, sir.
Yes, please.
Can we assume that interest is treated just like how we treat depreciation investment appraisal? How we deduct depreciation or capital allowance, then after the tax, we add it back. How interest is treated?
The interest, the benefit that you are getting on the interest. The benefit that you are getting on the interest has already been charged against your cost of capital. So if you are bringing the interest in and add it back, you are getting a double benefit on the interest. So the interest should not even come at all. If they are saying that you are using pre-tax cost of capital, then the interest should be charged. The interest will be it will be a cash flow, because you are going to be paying, unless the question is saying that is interest payable. So the interest is an actual cash that you are paying. Okay, the interest is an actual cash that you are paying. So if they are saying that you are using pre-tax cost of capital, then the interest should come as a deduction. But we always, even if you are not being told, we always use the after-tax cost of capital. So the benefit that you are going to be getting on the interest is already adjusted against your cost of capital. So you don't have to bring the interest into the calculation again. All right. So, Auntie Patricia, can we take question number 2?
Question 2.
Okay. Yeah.
Question 2. JJPLC in issue 50 million ordinary shares with a market price of 3.5 Ghana cedis each, ex div. For the year ended 31st December 2018, the company earnings per share and dividend payout ratio is expected to be 1 CD and 40% respectively. The company's dividend per share for the year ended 31st December 2004 was 0.2 Ghana cedis. 31st 2014 was 0.2 Ghana cedis. The company equity beta is 1.5. To raise 250 million Ghana cedis, JJPLC has issued a bond that will be redeemed at its par value of 100 Ghana cedis in 10 years' time and pays annual interest of 15%. The current ex-interest market price of the bond is 95 Ghana cedis. Ignore taxation. Additional market indicators are as follows. Sir, please, can you go up? Additional market indicators are as follows. Average sector price-in ratio, 8. Risk-free rate of return, 15%. Market risk premium, 10%. Required. Calculate the market value of JJPLC using the following methods. Price-earning ratio, dividend growth.
Okay. So there is no anything. Let's see what we can do here. So the company has an issue 50 million ordinary shares with a market value of 3.5 million as div. As div for the year ended 31 December 2018. The company's earnings per share and dividend payout ratio is expected to be 1 CD and 40% respectively. The company's dividends per share for the year ended 31 2014 was 0.2 million. The company's equity beta is 1.5%. To raise 250 million, JJC has issued a bond that will be redeemed at par value of 100 Ghana cedis in 10 years' time and pays annual interest of 15%. The current SDIV market price of the bond is 9%. Ignore taxation. Okay, so the additional market indicators are as follows. We have average one, we have the 8%, we have the risk-free rate of return 15%, we have the market risk premium. Calculate the market value of the JJPLC using the following methods: price earnings ratio. How do we calculate market value using price earning ratio?
The earnings
Understand.
B.
Okay, so we have question number 2, which will be A. Our price earning ratio is equal to the market on total basis, because this one they are asking for value, so we do it on total basis multiplied by the earnings attributable to them. So our market value, or our value of the entity, the value of JJ PLC is equal to the price earning ratio multiplied by a profit after tax. Okay, what is the price earning ratio given to us in the question?
8.
Okay, that will be 8.
That's 8.
Okay, so the 8 multiplied by, what is our earnings per share?
1.
1.
Okay, the earnings per share is 1, but we are looking for profit after tax, so we can say that will give us 50 million multiplied by 1. Do you agree?
Yes.
Okay, we have 50 million shares. We have 50 million shares, and we are
Market price.
having earnings per share of that. So what was the profit before we divided by the number of shares? We are having 1. That would be 50 million. Okay, so we now multiply the 80 multiplied by 50. We now be having 400 million. Is that correct? Okay. Nothing has been said about this, so adjust their figure by 20%. What are you having?
$320.
Okay. So you'll be having 320 million. Please, if they are asking you to find this per share, that's why we use the earnings. We just use the earnings per share. The question is asking you to calculate the value. They say you should calculate the value of these people. Okay, calculate the market value of JJPLC using the following methods. They just ask you to calculate market value, not market value per share. Okay, so if they ask you market value, they are asking for total basis. So someone can also calculate the value per share and come and multiply by the number of shares. You'll be getting the same answer as what we are getting over here. Let's look at the next one where they are talking about dividend growth. Okay, the dividend growth is just that we play with the what? The dividend growth, we play with the what? The cost of equity.
Hello, sir.
Growth. Yes, yeah.
Sir, please, can you go back to the previous slide so I check some? Okay, thank you.
Okay, so if they say the dividend growth, we are just going to be playing with our.
We will now get PO square to DO
Okay. So now
plus
the PO is equal to DO.
DO 1 plus G all over E minus G.
Okay. So the dividend growth, we just play with the what? With our cost of equity and our dividend growth. So let's go and look for the dividends. What will be our dividend for? We are doing this on total basis, so let's use total dividends. Okay. What is our earnings per share for the current year? What is our earnings?
1.
Is 1. Our dividend payout ratio is what?
40%.
40.
Okay, so
40.
the dividend payout ratio is just the portion of the earnings that we are paying out as dividends. So if you are having earnings per share as 1 cedi and you are paying a dividend of 40 pesos, what is the value of the dividend that you are paying in terms of money?
0.4.
0.4.
Okay, so that will be 0.4, isn't it? But we want to calculate this on total basis. So what you do is that you have your 0.4 multiplied by the number of shares. So the dividend per share will be 0.4 per share. How many shares do we have? 15 million. So you multiply to get your total dividends. What we have to do is that we now have to calculate the value of the G. So we come and calculate our value of the G and also our value of equity. Okay.
And root.
What are we going to be, how do we calculate the cost of equity? Which method do you think we can use here?
The capital.
Okay.
Open.
You can also use the dividend one, but you don't use the dividend. If you are giving information on CAPM, use CAPM. So we can calculate the CAPM. Someone can also calculate the cost of equity using the dividend because they give you the market price and they also give you the dividends. So you can also calculate that, but don't use that. Use CAPM. CAPM is the one that is reflecting the risks associated with the. So let's use the cost of equity. Let's calculate the cost of equity by using CAPM. So we have risk-free rate of return plus the return on market minus the risk-free. Okay. So our risk-free is what?
15.
15. Okay. Risk free is 15. Okay.
Equity beta 1.5.
1.5. Okay. Our market risk premium is what?
10%.
Okay. The market risk premium is the difference between the return on the market and then the risk free. Okay, so you don't have to do anything there. You just bring those ones like that. So we'll be having KE is equal to 15% plus 15%. Is that correct? Okay. KE will now give us 30%, isn't it?
Yes.
Okay. Can we calculate our growth? Let's see.
Yeah, the end root of
Okay.
D1 over DO minus 1.
Okay. So let's see if we can calculate the D1 over D0 exponent 1 over n minus 1. So if you like, you can multiply by 100. If you like, you can leave it like that. What is our current dividend? The D1 is a current dividend. What is our current dividend now? 0.4. Okay. What is our initial dividend? The figure given to you.
0.2.
0.2.
Okay. So what we have to do now is that we have to determine the number of growth over there. So
4
1
years.
over, no, that cannot give you 4 years. Let's check that. Okay. The figure given to us is 20 what? The first one is 20.
2018
and
2014.
What date?
31st.
December 2014.
Yes.
Okay. This to 2015 will give us 1 year, isn't it?
Yes.
2015 to
2016.
okay. So we have 2015 to 2016 will give us 2016 to 2017 will give us what? And 2017 to 2018. Okay, this is how we determine the growth. From 2014 December to 2015 December, that is 1 year. 2015 December to 2016 December, that is another year. 2016 December to 2017 December, that is another 1 year. And 2017 December to 2018 December is another year. So we have the dividend has experienced what?
4 years.
4 years growth over this. So what are we getting?
1%.
Is what?
I'm using the fourth root too. The end root of, I'm getting 1.
1.
You get like 18.9%.
Okay.
Eighteen point
Nine.
what?
18.92.
Benjamin, can you sort yourself out?
Okay, let
I
me
got
check.
25.99.
Hey. $25.
0.99.
What is happening?
That is what I actually
So,
had. Then you see,
I
because
think that the interval
it's
it
four
should it's
minus
supposed to be
1.
3 years, but we use 4 years here. You're using the 4 years.
How shall we use 3 years?
So 2015 moving to 2016 is 1 year. 2016 to
No,
2017 1
we
year.
are giving the
Oh, okay.
It's
dividend
18.92.
Okay.
18 point what?
18.92.
18.92.
Okay.
18.92, yeah.
Yes. 92. Yeah.
18.92.
Okay, so this will give us 0.1892, isn't it? Divided by 0.3 minus 0.1892. What are we getting?
Hello, sir.
Yes, now.
So please, since we have the payout ratio, I was thinking we can also use, we can also multiply the retention ratio by the KE to get the brokers.
We can
We can multiply the retention ratio by the return on the equity to get the growth rate as well.
okay. If you
How-
do
When
that,
I did that, I had 18.
you cannot get the same answer. It will always give you a variable one. Okay.
Okay.
Because sometimes the actual return on equity will not be the same as the cost of equity. Okay. But they can also give allowance for that particular one. 60% multiplied by 30%. They can also do that for you. Are you okay? Okay.
Yes, sir.
Yeah. So what are we getting as a total?
$214,000, 214.66.
Can someone confirm the 214?
Yes, please. 214.65.
Okay.
Yeah, 66.
Okay. So that is it. It's not a big deal. Whenever they mention dividend growth, you just have to play with what? With the cost of equity, with the cost of equity and the dividend growth formula. That is what we are going to be doing. Let's take the B. We have less than 20 minutes. Let's see if we can finish that one together with the issues of the four, where you have the floor value and also the conversion premium. Okay, they haven't examined that one before, so maybe there can be an issue with that. Question number, let's take the question number, let's take the B.
B.
Yeah.
The statement of financial position of two companies, Accor Limited and Beryl Limited, as at 31st December 2022, are shown below. So the statement is there. Sir, please, can you go? No. Additional information. Accor Limited is proposing to acquire Beryl Limited by means of an issue of its own ordinary shares in exchange for the ordinary shares of Beryl Limited. The management of the two companies have availed the following information to assist in the takeover. Maintainable annual profit after tax attributable to equity shareholders. Accor Limited, 2,400,000. Beryl Limited, 1,500,000. Current market price per ordinary share. Accor 24, Beryl 27. Current earnings per share. Accor 2.4, Beryl 3. The corporate tax rate is 30%. The current earnings after tax attributable to equity holders of Beryl Limited is expected to grow by 5% into the unforeseeable future. Beryl Limited has a current cost of capital of 15%. Required. Using the following valuation basis and assuming no synergy effect accrue from the takeover, determine the total number of shares the directors of Accor Limited will have to offer to the shareholders of Beryl Limited. A. Net asset value basis. B. Earnings per share basis. C. Market value basis. D. Present value of future earnings basis. E. Differentiate between white knight and white square in relation to measures and acquisitions.
Thank you. All right, so this one they are asking for net asset basis. Okay, the net asset, how do we calculate the value of a company using the net asset? How do we do that? Net asset. Okay, so we just have the asset minus what?
Liabilities.
Okay, you don't have to, please, you don't have to suffer. What we are going to be doing is that just put your just put your shareholders fund over shareholders item over here. That is all. Just calculate the net assets from the shareholders value. You don't have to do the non-current assets plus net current assets. You can just do your shareholders fund, the ordinary share capital plus the share premium plus the profit and loss account. That will give you the net asset. The only time that we use the asset one is maybe you have to do adjustment to the asset, and there's no adjustment in this question. So what we do is we just have the what? Their share capital is what?
$10,000.
No, the share capital of the company that they want to buy.
Okay, 5,000.
Okay, 5,000. Their share premium is what?
200.
200.
And the profit and loss account is what?
400.
Okay, so that will just give you the value. So we are going to be using the two where you can use. So we can also use you can find a net asset. We can also find a net asset. We can find a net asset by using the share capital because there's no adjustment over there. We just bring in the capital items or the equity items. Then we have the share premium of 200. Then we have the retained earnings. The retained earnings.
You're 5,200.
Retained earnings of what?
400. 400.
Okay. That will give you 5,600. Or someone can also do the net asset by having total assets. So the total asset, we have the non-current what? Non-current asset of how much?
3,500. 3,500.
3,500. Okay. The net current asset is what?
2,600.
Okay. 2,600.
Minus the benches.
There's no adjustment to this one. So you just bring the book value. Sometimes they will give you some adjustment, and that adjustment will also affect your profits. Sometimes some of the adjustment will be profit or loss item, especially bad debts, especially issues of obsolete inventory, that the inventory is reducing. So sometimes they can give you those ones. So we have the 6,100. Then we now have the liabilities. The liability
10% debentures.
10% debentures is how much?
500.
500. Preference share. We are looking for only the value for the equity shareholders. So preference shares are all treated as what? As a liability. They are not part of the owners. How much are we getting for the preference share?
No.
Is it?
It's zero.
Is zero.
Zero.
So we have only 500 here. The difference will give us 5,600.
600.
Okay. They are asking for the number of shares that will be given to these people, isn't it? Okay. Let's see what the question is saying there. They say using the following valuation basis and assuming no synergy effect accrued from the takeover, determine the total number of shares the directors of Echo Limited will have to offer to the shareholders of Bero Limited. Okay, so if we are using the net asset basis, what is the value of the company?
The total
That's the amount.
Okay.
5,600.
5,600.
If we are giving them shares now, the shares will be issued at what price? If the
Carry
parent
market
give them
price
shares,
24.
24.
so the parent will issue the shares at what? At their current
24
market
cents.
price. So the number of shares that will be given to them will now be the 5,600 divided by what? 24. What are we getting?
24. 233.
So 5,400 divided by 230. Divided by 24 rather. 5,600 divided by 24. 5,600 divided by 24. I'm getting 233 something.
Yes.
Yeah, 233.
So they are keeping 3 zeros at the top there. So that will be, the shares will be
233,333.
okay. So this will be the number of shares that they have to be given to them. The parent will issue the shares to them at their current share price, which is the 24 what cedis, which is the 24 cedis. Okay, which will be the 24 cedis. So that is the net asset one. You don't have to stress yourself. That is the net asset one. The second one is the earnings per share basis. What do they mean by the earnings per share basis? What method are they saying the earnings per share basis?
You calculate the profit and divide by the number of shares.
Okay, so what method are we going to be using for that as a earnings per share basis? What method are they actually talking about?
Earnings by
Thank
They are asking for what? What method are they saying the earnings basis? Okay, they are asking for the price earning ratio basis. The price earning ratio. So the earnings basis is the price earning ratio. And we know that this is calculated as what? The value of the entity, the value of the entity, the value of Vero Limited will be equal to the price earning ratio multiplied by their earnings. Okay, let's come here. Is the company having market price?
Yes.
Is the company having market price?
Yes.
If the company is having market price, it means that the company itself is listed. Okay, whenever you are giving the company is having market price, it means that the company itself is listed. So you have to use their price earning ratio to value them. Okay, if you are giving the current market price of the company that you are going to be valuing, it means that the company is listed, and that is why they have a market value. If you're not listed, you cannot have a current market value. So they are listed, and we have to calculate their price earning ratio and use it to value them. Okay, so we have to calculate the price earning ratio for them and use that to what? To value them. So we have, okay. Okay, so let's use that to value them now. Let's calculate the price earning ratio for them themselves. Let's use their own price earning ratio. Okay, the price earning ratio for them will be the market price divided by the earnings per share. Is that correct?
Yes. That
Okay.
would be 9.
Okay, that will give us 9. Okay, so we now find the value of them by using their own price earning ratio. So the one that you are going to be valuing, you assume that the company is not listed and they are not having market price. So you use a price earning ratio of what? Of a similar company that is listed. But if you are giving a market price of that particular company, it means that that particular company is a listed company on its own. So we now have our price earning ratio multiplied by, we are looking for total value. So what would be their current earnings? What will be their total current earnings?
1,500,000.
Okay. Confirm that also. Confirm that for me. We know that their current earnings per share is 3 cedis. And what is the number of shares that they have? What will be the number of shares? We know that shares, a certain number of shares are issued at 10 cedi and they are having 5,000. So the number of shares will be
500,000.
500.
So that will be 5,000 divided by 10, isn't it? Okay.
Yes.
Multiply by the 3 cedis over there will give us what? The 1.5. Because there are 3 zeros at the top. So it means that this profit over here is the same as their current earnings per share. Okay. So let's multiply this by the 1,000 or 1.5 million. What are you getting?
$13.5 million.
Okay, 13. Okay, so 13.5 million. So this is the value of the company using the earnings basis. But let's count the number of shares that will be given to them. What will be the number of shares? They will now, the predator company will now give them a certain number of shares at what? 24 cedis. Is that correct?
Yes.
Okay. What are we getting? I'm getting 562.
Yeah.
562, 500.
Okay. Let's be moving on. Let's just be moving on. Okay. Let's come to the other one. Let's use market value basis. What do they mean by the market value basis? Someone should help us with the market value basis.
The
Any
number
year.
of shares times the current market price per share.
That is all. So the market value basis is there. What is their current market value? What is their current market value, or what we call the market capitalization basis? So their market value basis is what is the value of their equity shares now. So we have the market value basis will be calculated as the value of the company, the value of Barrow will be equal to their current price is 27, isn't it? Their current market price is 27 cedis. Can we confirm that?
Yes.
Okay. Then multiply by
The number of shares.
So multiply by the number of shares, which we can calculate as the 5 million divided by 10. So we can have 27 multiplied by 500,000. What are we having for them?
$13.5.
Okay. That also be 13.5. Okay. And this will also be, so the number of shares will still be the same price. Okay. So the number of shares will still be the 562, isn't it? Okay. That will still be 562. Please, if you use if you use the price earning ratio of the parent company to value them to, they won't do anything for you. Okay. If you calculate the price earning ratio of the parent company, which will give you 10, and use the 10 to value the other company, so there is no problem with that. They will still mark you. But if the company is actually having their own value, you have to now use their what? Their price earning ratio. So let's also look at a situation where we'll be using the price earning ratio of the parent itself. Okay, so let's try that one also, so that you can have so many. So you can also use the price earning ratio of the parents, which will be calculated as 24 over 2.4 multiplied now by their profit of 150,000. So you'll be having 10 multiplied by 150,000 or 1.5 million, and we'll be having a value of what? So the value of this particular company, which is a barrel company, will be 15 million, will be 15 million. Okay, so you can also adjust this by 80% because you are using the value of the parent company. Although the subsidiary value is higher than the parent company, so but since we assume that the subsidiary is not having value, you can adjust this by 20%. What are we going to be having for the subsidiary? Okay, that will give us 12 million. Okay, and these 12 million, the parent will now give them shares at 24. So what will be the number of shares?
Yes.
It will be
500,000.
okay. So 500,000 shares. If you calculate something like this too, there is nothing that they won't do anything. They will still market. You are assuming that the parent is going to be valuing them using their what? Their current price earning ratio. Okay, let's look at the last one. Then we see what we can do. Okay, present value of future earnings. Present value of future what? Earnings. Present value of future earnings. Present value of future earnings. What is the current earnings of this particular company? It's 1.5, isn't it? Okay. So let's come to present value of future earnings. Okay. So if you are talking about present value of future earnings, it's just like they will always give you something about, they'll always give you something about the earnings growing or something. So you just find the present value of that. They are saying that the current earnings after tax attributable to the equity holders of Beryl Limited is expected to grow by 5% into the foreseeable future. Beryl Limited has a current cost of capital of what? 15%. Okay, so if we want to find the earnings, if we want to find the present value of the earnings right now, what do? The present value of the earnings, present value of the earnings. This earnings that is given to us right now is the current value, but they are talking about future earnings. What will be the earnings in the following year? That's what we are going to be using to find the present value. So what you do over here is that you using the present value of the earnings, your value of Beryl Limited will be calculated in the line of, so you have your earnings, okay, which will be the future earnings, the next year earnings, that will be 1 plus the growth divided by the earnings yield, okay, the earnings yield minus the growth, or the earnings yield over here, you can just make it to be maybe the cost of capital given to you, okay. You can decide to calculate the earnings one, or you can just use the cost of capital to them, okay. The current earnings over here is 1.5 million, and this is going to be growing at 5%, so 0.05. Okay, let me take this one off. Okay, so our value of this particular company, value of barrel is going to be giving you the current earnings of 1.5 million into bracket 1 plus 0.5. Please, this is current earnings. If you are finding present value, we find present value for what? For future cash flows. So what will be the earnings that will be arising in the next year? This will grow by what? 5%. That's what they are talking about there. And our current cost of capital is 0.15 minus 0.05, which is the growth. If you also like, you can calculate the earnings yield of this particular entity. How do we calculate the earnings yield? That will be 3, or the earnings per share over the market value multiplied by 100. You are going to be getting 10% or 11%. You can still use it. But they have given you the cost of capital for a reason. So use the cost of capital for your future earnings calculation. So use your cost of capital for the future earnings calculation. Okay. So what are we going to be having at the top there? At the top,
everything will be 15 million 750,000.
everything will be
15 million 750,000.
15 million 750,000.
Yes.
Okay, 15 million 750,000. Okay, what will be the number of shares that will be given to them?
Six 6250.
Okay.
656250.
Okay, 656250. Okay. All right. So, sorry, Manuel. Let's take the last one. Those ones there. You can. This is about valuation of debt. Okay, the question 3 and 4 are valuation of debt. Okay, let's see. Maybe tomorrow we have class at dawn. Okay, differentiate between white knight and what? White skew. White skew or skew in relation to mergers and acquisition. What do you mean by white knight? Okay, I hope we can remember that one of the defensive tactics, we say that the target company will go and look for what? Another company to come and purchase them, isn't it?
Yes.
Okay. The another company, what they normally do is that they will go and look for a company that is related. Okay, they'll go and look for a related company, a company that they have relationship with. So they'll go and look for that company to come and purchase the entire shares, their entire shareholding, 100% of their entire shareholding. So maybe the company that is coming to the predator company might not be a related company to them. So the predator company might not be a related company, or they don't want to sell to the predator company. So it's just like you have a company that you have your brother there. If you ask your brother to buy, he will show interest, and I want to come and buy. I'm not related to you. So you can avoid selling the company to me by telling your brother to come and buy 100% of the what? Of the shareholding. And that is it. That is what we call a white knight. So the company will look for a related company, or the company will now sell the what? 100% of their shareholding to what? To a related what? Party or a related company. But if you come to the white skew, what will happen is that the related party will not buy the full 100%, but it will buy the majority of what? Of the shares. That is only the difference. For the white knight, the related company is coming to buy the entire shareholding, 100% of the shareholding. But if you count to the white skew, what happens is that the related party will buy a majority, but they will not buy the entire or the 100%. That is the difference between them. Yes. Oh, okay. So that is it. Cost of capital and business valuation. Please, I said that they can ask you some questions on the mergers and acquisition, advantages of acquisition, and also maybe reasons why mergers and acquisitions sometimes does not achieve the desired result. I've mentioned things like integration problems, acquisition premium, uh, management, lack of expertise to control or to run the acquired company. There are a lot of issues there. So they can ask you a question. They can give you a question on business valuation, and they also ask you theory question. It's going to be 20 marks, but you cannot, it is not possible that you see all of them to be 20 marks. There will always be a theory question on the business valuation. Please, any question? All right. So if there are no questions, I'll see you guys are done. Good night. Sleep well. Take care.